the parent
and
company
financial liability. So financial asset is whereby a company will have invested or a company will purchase debentures or what? Both. So if you invest, you purchase both or debentures, to you is an asset. But if a company issue debentures or if a company issue both, to the company is a financial liability. So that company is a financial good liability, because once a company issue both, once a company issue debentures, the company has an obligation to pay cash. Now, which cash will our company be required to pay here? Assuming our company issues both or basically debentures having a life of 3 years. It basically means that this company over the next 3 years, at the end of each year, our company has to pay interest.
10% of the shares
has to pay interest. Once the 3 years comes to an end, the company will have to do what? To redeem those particular debentures or both in terms of paying back the principal amount, in terms of paying back the principal amount. So therefore, here you can see our company has entered into a contract, and in that contract, the company has an obligation to do what? To pay cash. Yes. Now, in this case, we have two categories of financial liabilities, but maybe we will discuss on one, because that is the one which is very common. So we have
40%
financial liability.
So in this case, you'll see that on this
fair value,
the parent company will
at fair value through able to acquire the. So basically, these ones are not common. I will not even discuss that. Whereby but basically just know we have two categories, and then number two, we have financial liability at amortized cost. These are the common, the common type of what? Of financial liabilities through the common type of financial liabilities which are issued by the company. The financial liabilities at amortized cost. Now this are basically the debt instruments which are issued by the company in the debentures of both.
Number one, we have
supposed to be redeemed after a number of years. In other terms, we can say that these are the debt instruments which are issued by the company. They have a fixed rate. They have a fixed rate. A fixed rate means, for example, a company can be told a company issued debentures or basically both having a life of 3 years. Having a life of 3 years means that those debentures or those both can only be redeemed by the company at the end of the 3rd year. Can only be redeemed by the company at the end of the 3rd year. They have a fixed rate. They have a fixed rate. So therefore, that's why we are saying that these are the common type of what? These are the common type of financial liabilities which are basically issued by what? By the company. Now, what you then need to know, as far as these financial liabilities are concerned, are two things. Because the amount for initial recognition, how do we determine the amount for initial recognition, and how we determine the amount for subsequent measurement? How do we determine from the amount for initial percent? Because we amount for initial, the parent company has acquired recognition between 20% to 49%. Amount for initial recognition is an associate, and basically the parent company acquire exactly 50% of the shares. These are joint subsequent measurement. So when we talk about the amount for subsequent measurement, we are referring to the amount percent to 100% financial liabilities. Companies work. The amount at which these financial liabilities so therefore, talk about will be recorded in the company's statement of financial position at the end of each year. Now, the amount for initial recognition, or once the company issues debt instrument having a fixed value, they are initially recorded in the company's books of account at what? The fair value of purchase consideration. 20%. That one should be the fair value of purchase consideration asset. So therefore, we may have a scenario whereby the fair value of purchase consideration received. How much amount was received by the company? Fair value of purchase consideration received, and this minus any transaction cost. Minus any transaction, a joint venture, any transaction cost. Like in this case, we can be told a company issued debentures, and those debentures which were issued, they were issued, or the company issued them at an amount of 200 million. In terms of how we 200 million, the company issued shillings 200 million debentures account for that investment. But during the issue, the company incurred the transaction cost of maybe 3 million. This is the transaction cost which was incurred by the company. So the amount for initial recognition will be equal to the fair value of purchase consideration received. The amount the company received is 200 million. We minus the transaction cost. The transaction cost is the cost incurred in the year issue, which is 2 million. So the amount for initial recognition therefore will be 198 million. So the purchase consideration received minus any transaction cost. Then, what about the amount for subsequent measurement? The amount for subsequent measurement, this one is equal to the amortized cost. This one is equal to the amortized cost. Now, for us to be able to determine this amortized cost, we must prepare something called the amortization schedule.
became a subsidiary.
we must prepare something called the amortization schedule. The amortization schedule is similar to what we have done here, although we will be able to see there is a slight difference because what we are dealing with here is a financial liability. What we have dealt with in the other question was a financial asset. We will be able to see there is a slight difference in terms of how we prepare the amortization schedule in case of a financial asset and also in case of a financial liability. So I want us to do a question on this once we come back after a short break. There was a question which was examined on this
consolidated statement of
in this
profit
the sitting of
consolidated
the sitting of April of 2025.
In terms of how we prepare these ones, so basically what we need to do is to establish
those papers
the status of the investee company during the current financial year. So when we talk about the investee company, this is the investee company, because I hope you can be able to recall in our previous class
in the class
that the parent company here, taking into account it has invested in this company, the parent company here is the investor company.
So we have this question here, April of 2025
investee company. So what we are saying is that for us to be able
this
to
was
prepare this
specifically
one, in case
question
of a
number
piecemeal or stage acquisition, we need to establish the status of this
question
company
number 4.
in also what the current financial year. For example, in this case, we may be told that the parent company initially had acquired maybe something like 20% of the shares, 20% of the shares, something back.
I want us to take a short break of
6 months to the
how many
end
minutes?
of the year.
We can just take a
the
short break
parent
of just 5 minutes. 5 minutes.
Additional 40%.
We come back. Make sure
So
you
take
have
into
that question
account
with you.
the parent
The
company
question
initially
for
had
April
acquired
2025,
shareholding.
April
And during the
2025, question
current
4.
year, 6 months to the end of the year, the
let's come
parent
back after
company
the short break
acquired
of 5 minutes,
additional
and then we'll
40% shareholding. It basically means that the parent company now here
so I want us to proceed. Let's proceed. Let's proceed. Continue. So that we wind up with this particular question here. A small one. But you'll also be able to see that it involves some workings here. So what are we told? I hope you have that question with you. I've been seeing that. Do you have that question with you, Jeffa? Stephen, do you have that question with you?
As per the information which is given,
do you have that question with you?
Paragraph 1.
Lydian,
And therefore, the first thing we need to do here
is so what are we told here? A small question, question number 4.
Take into account the question for group
on 1st January 2021, Trade Limited issued shillings 20 million.
Here, the group structure.
Issued shillings 20 million, 8% raw notes at a discount of 5%. The issue cost amounted to shillings a million.
The information in paragraph 1.
That is, then in paragraph 2, you're told the raw notes were redeemable on 31st of December 2024 at a premium of 1,130,000. The effective interest rate will be called, therefore, is 12.5%. So we are told this suitable calculation illustrates the accounting treatment of the above transaction from 1st January 2021 to 31st of December 2024 in the financial statement of Trade Limited in accordance with IFRS 9 financial instrument recognition and measurement. Round your answer to the nearest 1,000. To the nearest one on which 1,000. So we are told this company, first of all, which is called Trade Limited, issued shillings 20 million, 8%. So we have said if a company issued debt instrument, raw notes and debt instrument, basically this is a financial liability. And actually you have said that because they have a fixed rate, because you can see that these raw notes will be redeemed on 31st of December 2024. So these are debt instruments issued by the company. They have a fixed rate. So basically what that means is that these are financial liabilities and amortized cost. So we can say this word. So we are told this company owns a further. That is basically for your revision is not required by the examiner. Here we can say this raw note issued for a cash consideration of issued by who? Issued by what that means is that limited is what company here is a financial by the end of the liability acquired able to acquire the amortized cost, because you can see is a financial liability at amortized cost. Now having done that, we need to proceed and basically determine amount for. So therefore, this initial recognition when the parent company amount for initial over who for initial limited. And therefore, you recognition. Remember, this date were issued on which date? On that they were issued on 1st January. The parent company acquired what? 20. So I think in our case we already have the 1st January 2021. We already have the group structure. And I think if we go through the other information, note number 2. Note number 3, 4. Now, for us to be able to determine this, you must remember the formula which I've given you, and we have seen that the amount for initial recognition is equal to the fair value of the purchase consideration
we can go through the
fair value of purchase consideration which was received,
So note number 1
minus any transaction cost,
in note number 1
minus any
limited acquired a further
transaction
30% interest
cost,
in 𝐻𝐍 Limited
minus any
on 1st of
transaction
April
cost.
2019 for a cash
How much amount was received, and then to that we list the transaction cost. Have we given this information? Yes. Let's go back to paragraph 1. And basically, we're told that on 1st January 2021, this company issued shares worth 20 million. This 20 million is the face, the nominal or the par value, 8% loan note at a discount of 5%.
shareholding
At a discount of 5%. In this case, you can see
the
the loan note issued, they had a face value of 20 million, but were they issued the 20 million? No, we are told they were issued at a discount of 5%. So therefore, the amount
in
received,
computing the
the purchase consideration received by our company here, this one will be equal to 95% or 20 million. 95% of 20 million because they were issued at a discount of 5%. So this is the fair value of purchase consideration received, and then to this we minus the transaction cost. Do we have transaction cost incurred by our company here? Yes. We are told in the first paragraph, the last sentence, the issue cost amounted to 1 million. There was an issue cost. The issue cost is the transaction cost, which is basically what? 1 million. And I think what we need to do, equally, if you check on the requirement, we are told to work with our figures to the nearest 1,000 of shillings. So just like what you've done in the other question, we will work with all our figures in 1,000 of shillings. We omit the last 3 zeros.
Revalued what?
Yes. So we take 95% of this, and then we minus the transaction cost. We minus the transaction cost. This will give us
exceeded its carrying amount by 150 million.
95%.
Okay, we are told an item of
times 20
exceeded its carrying amount by
minus 1,000, and that will give us what? That will give us 18 million. That will give us
this item of
18 million. This is basically the amount for this recognition. In this case, you may show the accounting entry. So this amount, how was it supposed to be accounted for by our company?
Adjustment. Remember,
so this case, our company received the money. So the amount, this is the money which was received by the company after issuing. So the company debited that in the bank. The amount was debited in the bank and then credited in a liability account called the financial liability at amortized cost. This is basically a liability account which was credited with the amount which was received. Having determined the amount for initial recognition, we need to move and basically determine the amount for subsequent measurement.
Is the plant, and actually
for subsequent here measurement. Remember, this amount for subsequent measurement is basically the amount at which this financial liabilities or the amount at which this loan note will be recorded or supposed to be recorded in the company's statement of financial position. I think over the period of 4 years. So this, if you can be able to recall, we are saying the amount for subsequent measurement is always equal to the amortized. Now this is always equal to the amortized cost. And actually, we have said that this. So the amortized cost will have, or actually we're going to determine this amortized cost by basically preparing something called the amortization.
This one is a pre-acquisition revaluation gain, and therefore this one would be used in the computation of goodwill. When computing the goodwill arising on acquisition of this is one of the pre-acquisition reserve. Number 2, we need to compute the depreciation under charge. The depreciation under charge. And basically that depreciation under charge is by 𝐻𝐍 Limited. By 𝐻𝐍 Limited. I hope you can be able to recall the formula which we use here. We take the revaluation gain, that is the formula which we use, divided by the remaining useful life of the asset times the proportion of time. The proportion of time. The proportion of time is the time difference between the date of acquisition and the date of consolidation. In this case, when we talk about the date of acquisition, is basically the date when the parent company acquired the control. Not this date, but the date when the parent company acquired the control. Because in fact, the assets were revalued on this date, not on that date, on this date. Sasa? Yes. So therefore, the revaluation gain in our case is 150 million. We divide that with the remaining useful life, which are basically 6 years, times the proportion of time. So how many, I think in our case, we have some few months here,
because we need to identify the number of months, or basically the number of years we have between these two dates. That is this date here, which we are referring to as the date of acquisition and the date of consolidation. The date of consolidation is the date we are required to prepare the group accounts. So if you go to the requirement, which is our date of consolidation in our requirement, the date of consolidation. The date of consolidation. Who can see that date? The date of consolidation. Yes, the date of consolidation is 31st of March 2019. 31st of March 2019. 31st of March 2019. 31st, oh, sorry, not 2019, sorry. Yeah. Yes, should be 2023. Sorry for that. Should be 2023. Should be 2023. Yes. Should be 2023. Yes. Let me get it clear before we move. Yes. So if we go to note number 1, our parent company acquired additional investment on that date, which is correct. And then the date we are required to prepare the group accounts is per note number as per requirement C. Yes. So should be 31st of March 2023. Yes, actually here we don't have months, but basically we have a number of years. How many years do we have here? How many years do we have here? The first year automatically added 31st of March 2020, 2020, 2021, 2022, 2023. 1, 2, 3, 4. How many years? Do we have 4 or 5 years? Fred is saying we have 5 years. Do we have 4 or 5 years between those two dates? How many years do we have? We have 4, because we have said that the first year did 2020, 2021, 2022, 2023. Yes, we have 4 years. So meaning that we are computing depreciation under charge for how many years? For 4 years. So let's work out this. Let's work out this. Let's work out this. So this one will give us 100. Now this 100, number 1, this one will be deducted from the group PP. This one will be deducted from the group PP. And number 2, this one will also be deducted from the retained earnings of S Limited. We also deduct that from the retained earnings of S Limited. But the key adjustment is this one, because we said in most of these questions for group account, by the end of the day, you don't have to compute the group retained earnings. And actually, this one we are going to use it in computing the group retained earnings. Let's move to point 2 of note 2. And we are told on 1st of April 2019, the same date, the directors of H Limited identified that S Limited had internally generated database of customers who had the potential of purchasing their product for identifiable period of time. So although there were no contractual or legal rights associated with the database, a professional expert estimated that a competitor of S Limited would be prepared to pay 90 million for this database. Now, even before we move to the last point, if you have a database of customers, database of customers, and who you can be able to sell, you can be able to sell this database to the competitors. You recognize this as what? In your books of account. What is this in your books of account? This database of customers you can be able to sell to your competitors, or you can be able to use. In terms of advertising, you can be able to sell some messages to these customers, and basically they'll come and buy. They'll come and buy. Some of them, not all of them automatically. Yes. Yes, basically this one is recognized. This one is supposed to be recognized as an intangible asset. This one is supposed to be recognized as what? As an intangible asset. You recognize this as what? As an intangible asset. Sasa, Yes. So therefore, this database of customers will be recognized as a database, of which you can, what you're told in the last point, we are told that 𝐻 Limited had not recognized the database as an asset in its individual financial statement. So basically, this is an intangible asset, and you can see its value was established on the date this company was acquired. So therefore, what we need to do in relation to that point, we have said that that database of customers is an intangible asset, and we are told the value for that intangible asset is how much? 90 million. So this one will be recognized within the consolidated statement of financial position as an intangible asset. And number two, because it was revalued, so then we also recognize this as a pre-acquisition revaluation gain, because you can see this is a database which existed, but its value had not been established. It was revalued. It was what? Revalued. Sasa? Yes. It was revalued. The other thing you also need to determine as far as this is concerned, in case you're told this intangible asset has a definite life. Has a definite what? A definite life, you need to compute its amortization, because in such a case, if you're told it has definite life, you must be given the expected useful life. Now, there is something which you're told in that point, that this database can be able to buy from this business for an indefinite period of time. So meaning that in this case, we don't have to amortize this. We don't have to do what? To amortize this. But if you are told that these customers are likely to buy from this company for a definite period of time, will be given the estimated life, you have to do what? You have to determine the amortization. Sasa? Yes, but in this case, no amortization. We just recognize that as an asset. And number two, because it was revalued on the date of acquisition, we do what? We recognize it as a pre-acquisition revaluation gain. So someone is asking, where was 90 million? Now, basically, if you read on that point, what you are told, we are told this is a database which existed in the company. And actually, on the date 𝐻 Limited acquired S, that is the moment the directors of this company were able to determine the value of that database of customers. That basically what you're told. If you read that point very well, that's what you're told, that the directors of 𝐻 Limited identified that 𝐻 Limited had internally generated database of customers. So means that the directors of 𝐻 Limited, after acquiring this, that is the moment they were able to establish there was this database, which you are saying, then it needs to be recognized as what? As an asset. Was this database acquired from another company? No, it was an internally generated. So if it was internally generated, it was revalued. Sasa? Yes, you come up with a value for that database of customer. You have done what? You have developed. So you are not acquiring that. If it was acquired, maybe that one should be credited in the bank. Sasa? Yes. But it was revalued. So that is basically the treatment for that. So then we are done with that. I hope that is clear. So let's move to point number 3. In point number 3, we are told the group policy is to measure the non-controlling interest at their proportionate share of the net asset in the subsidiary at the date of acquisition. Automatically, this point is to help you to know which method you're going to use in the computation of goodwill. Which method are we going to use here in computing the goodwill? Are we going to use the full goodwill method, or are we going to use the partial? The full goodwill method or the partial? Yes, automatically here, we do what? We use the partial. We use what? The partial goodwill method. So note number 4, we are told on 28th of March 2023, these are few days to the end of the year, 𝐻 Limited sold goods worth 100 million to 𝐻 Limited. So 𝐻 sold goods to 𝐻 Limited. And then you're told 𝐻 Limited reported a gross profit margin of 20% on these goods. And then you're told 𝐻 Limited had neither received nor recorded these goods in its books of account as at 31st of March 2023. Now, this is basically a consolidation, which you said is not very common. but you'll come across that consolidation adjustment in a number of questions, but not all questions. In fact, that consolidation adjustment is not common. You'll be able to see most of the questions we will do. You'll not come across that, but basically that we refer to that as the goods in transit. The goods in what? The goods in transit, GIT, the goods in transit. Now, for this particular goods in transit, basically, how many adjustments do we make in relation to this? How many adjustments do we make in relation to this? I think like 3 adjustments. 3 adjustments which we make in relation to this. Let me briefly explain. Like in this case, we are told which company made the sales. We are told H Limited. H Limited basically sold some goods now to S Limited, but S Limited had not received nor accounted for those goods. Those goods we refer to them as goods in transit. Now, the first thing we need to do is basically to recognize those goods in the books of account of S, because they were not received nor accounted for by S. How do we recognize them in the books of this? We add them to the group inventory because they are supposed to be part of the inventory of this. And then number 2, this company will need to pay for those goods. We also add them to the group payables. We also add them to the group what? Payables. Sasa, that is first of all to recognize those goods. To recognize those what? Those goods. Number 2, because this company sold some goods to this company automatically made a profit. Now, the profit which was made by this, the full amount will not be realized. The full amount of profit will not be what? Recognized. Sorry, will not be realized. That is, will not be realized. Simply because we say that if this company sells some goods to this, the profit which is made by the selling company can only be realized if the goods are sold to third parties. So therefore, we need to compute the unrealized profit on goods in transit. So this one is computed by taking all the goods in transit times the gross profit margin. Then number 3, this company had not received and accounted for those goods. Automatically, it had not paid for them. That will also give rise to amount of intercompany debt. The amount of intercompany what? Debt. So therefore, as far as the goods in transit is concerned, and that's why this adjustment is not that common, because you can see it requires like 3 adjustments. As far as the goods in transit are concerned, we make those 3 adjustments. Those 3 what? Adjustments. So therefore, number 1, we have said what we need to do is to recognize the goods. To recognize goods in transit in the books of account of S. So the goods in transit, they had a value of 100 million. 100 million. 100 million. So this one, we add this to the group inventory. And then we also add this to the group payables. That is the first adjustment, to recognize the goods in the books of account of who? Of S. Sasa, number 2, we need to compute the unrealized profit. Unrealized profit on the goods in what? In transit, of which this unrealized profit is always by the selling company. The selling company was was H. This one, or this is unrealized profit by H. So how do we compute this? We use that formula here. The goods in transit times the gross profit margin. So the goods in transit, 100 million. 100 million, I hope you can see that, 100 million times the gross profit margin. The gross profit margin is 20%. This will give us 20 million. This one, we less it from the group inventory. And number 2, we less it from the retained earnings of the selling company. The retained earnings of the selling company, that is who? That is the H Limited. H Limited is the selling company. H Limited is the selling company. Then the last adjustment is that these goods also give rise to something called the amount of intercompany debt. Amount of intercompany debt. But in most of the cases, you may also be told that there was another amount of intercompany debt. For example, if you go to that point Actually, that is given in point number 5. Let's go to point number 5. In point number 5, we are told the current account between H and S did not agree due to the goods that remained in transit as per note number 4. As per 31st of March 2023, the trade receivables of H Limited included 600 million from S Limited. Now, that is all about the amount of intercompany debt. But in that case, in the first sentence, we are told the current account of H Limited and S did not agree due to the goods in transit that remained in transit as per note number 4. So, and then you are told that the trade receivables of H Limited included 600 million due from S. Due from what? Due from S. In other terms, what that means is that this company here, that is H Limited, was expecting to receive 600 million from who? From S. So we need to determine how much amount was included within the trade payables of H Limited. Not S, not H, rather S. How much amount was included in the trade payables of this? The trade payables of the subsidiary, because we are told the parent company was expecting to receive 600 million from S. How much amount was supposed to be paid by who? By S to H. And also you must take into account what we have in note number 5. That is note number 4. Note number 4. Who can tell us how much amount was included in the payables of S? Because we are told in note number 5, the current account of H Limited and S did not agree due to the goods that remained in transit as per note number what? As per note number 4. And then you're told that as at 31st of March 2023, the trade receivables of H included 600 million due from who? Due from S. Due from S. Due from S. Now, who can tell us how much amount was included in the payables of S? How much amount was included in the payables? I'm told it's 600. But remember, we are told that the amount which should be included in the payables of these should not be the same with the amount included in the receivables of these due to what? Due to the goods in transit. Remember the goods in transit? As per note number 4, the goods in transit had a value of this one. So how much amount then was included in the books of account of this? Now, what you just need to note here, I'm told 700, I'm told 120, 600. Now, what you need to note here is that once the parent company here sells some goods to this, are we together? So once this parent company sells some goods to this, so this company accounted for that as sales. This company, that is H Limited, when it sold these particular goods of 100 million, the parent company accounted for that as receivables. So this 100 million is already included here. Is already included in the receivables of the parent. Are we together? Is already included here. And so this company debited the receivables and then credited sales. Credited sales was sales account with 100 million. But now, this company here had not received and accounted for these goods. Had not received and accounted for that good. Now, how much amount initially, before accounting for this, did the subsidiary company owe the parent? That is now the question I'm asking here. Before the subsidiary accounted for, because it had not received and accounted for this good, how much amount did it was owed by the subsidiary to the parent? Yes, that is very much correct. The amount which was included here was 500. Was what? Was 500. And that's why we have said for us to be able to make this to amount to reconcile, for us to be able to make this to amount to reconcile, that's why we have this. Where do we have that? Yes, that's why we have this here. So because this company, once the subsidiary recognized, this 100 million will be added here. Will be what? Will be added here. So this one will be added here. By the end of the day, you'll be able to see that the amount included in the receivables of this is 600 million. The amount included in the payables of this is how much? 600 million. So by the end of the day, those current accounts will do what? Will agree. Will do what? Will agree. Sasa, yes, that's basically what was required here. So therefore, that's basically how we deal with the goods in transit. Recognize the goods, compute the amount of unrealized profit, and then determine the amount of intercompany debt. We are done with that. Let's move to the other point, which is point number 6. And you're told an impairment review carried out at the end of the year revealed that neither goodwill arising on acquisition nor the intangible assets. Remember, the intangible asset is this customer's database. This customer's database with infinite useful life had been impaired. So no impairment loss on goodwill. Number 7, you're told to ignore any deferred tax, consequences on acquisition and fair value measurement. And 8, 𝐻 Limited had not issued any ordinary shares since the date of acquisition. It basically means that since this company was acquired on this date, its share capital has remained the same. And I think we are done. So this question was a very simple one, provided you're able to, I think this was the only tricky note, but once you're able to deal with that note, then the question becomes quite simple. You'll be able to see the requirements, what we are required to compute there is something very simple. I don't know whether what is our time here? Let me see. Yes, I think I can give you a short break of just how many minutes? Yes, I think I can just give you a break of 8 minutes. We come back at 7:20. Then we finish on what is remaining. What is remaining should not take us even more than 30 minutes. Yes. So let's take that short break. We come back at 7:20. We continue with what is remaining. Yes, so we continue, and I want us to start with the part A of the question. So if you're back, please confirm. Are you back? Grace, Daniel, are you back? Mike, Patrice, are you back? So if you're back, please confirm. I want us to start with part A. Okay, so let's start with part A. And basically what you're required to do is we determine the equity accounted value of the investment in 𝐻 Limited on 31st of March 2019. In other terms, what you're required to do here in Roman 1 or in part A is we determine the investment in associate, on this date here. Remember, this company here that is 𝐻 Limited, or basically the parent company acquired initially 40% of the shares in S. So 𝐻 Limited was initially what? Was initially an associate. So what we are required to do is we determine the investment in associate on this date. The date the parent company acquired the control, or what was the value of the investment in associate before this company became a subsidiary. Became what? A subsidiary. So therefore, we are required to compute the investment in associate. So remember, associate is basically 𝐻 Limited. On which date? On 1st of April 2019, which is the same with 31st of March 2019. Are the two dates the same? Yes. 1st of April 2019 is the same with what? 31st of March 2019. So how do we compute this one? So the same approach we use in computing the investment in what? Associate. So remember, our figures are in million of shillings. So we will start with the cost of investment. the cost of investment, how much amount was paid by the parent company in acquiring 40% shareholding, and then to this we add the group share of the post-acquisition retained earnings. So to compute this, that is the group share of post-acquisition retained earnings. If we go back to that question, you'll be able to see we are given the retained earnings of this company between these two dates. Between those two dates. So the difference between the retained earnings between these two dates will be the post-acquisition retained earnings. And basically we get the group share of that, which will be 40%. So and then to this we said we less any impairment loss. Any impairment loss, of which there is some information which are given in note number 6, where we are told that the investment in associate had not impaired. So therefore, what is the cost of investment? When the parent company acquired 40% shareholding in S, how much amount was paid? That information, we have it within paragraph 1. Let's go back to paragraph 1 of our question. Specifically sentence 2, we are told H Limited acquired 40% ordinary shareholding in S on 1st of April 2013 for 2,500 million. So that is 2,500 million, the cost of investment. And also in the same point you are told, when the retained earnings stood at 360. So the retained earnings on this date was 360 million. And I think also we are given the retained earnings of this date. The retained earnings on the date the parent company acquired the control, and that is in note number 1. In note number 1, sentence 2, we are told at this date, that is the date when the parent company acquired the control, the retained earnings of S was 860. So the post-acquisition retained earnings of this company here will be the difference between these two retained earnings. Because this one is pre-acquisition retained earnings, whereas this 860 is post plus pre-acquisition retained earnings. Sasa, yes, so this is comprises of both pre and post, and then the pre is how much? Is 360. So the post-acquisition will be the difference between those two retained earnings, 860 minus 360. So basically, which will give us what? 500, and then we get the parent company share of that. The parent company share of that will be 40%. 40% of this. 40% of this, or basically 0.4. So and that will give us what? That will give us 200. 200. Is it 200? 500 times 40%. 200, yes. So we add these two values here, and basically that will give us what? That will give us 27. So this basically what was required in Roman 1 of that question, and the marks allocated there were just 2 marks. So that and that, 2 marks. So we move to part B of the question. Part B of the question, and what are we required to do? We are required to compute the goodwill arising on acquisition of S. So the goodwill on acquisition of S, on acquisition of who? S Limited. And remember, as per the information we have in note number 3, we are computing this goodwill using the partial goodwill method. As per the information we have in note number 3, we are using the partial goodwill method. So here we need to have, let's just have 2 columns. We have 2 columns like that. 2 columns, and also our figures are in million of shillings. So how do we compute this goodwill? Remember, I've given you the format for computing the goodwill arising from piecemeal acquisition. One, we have said we compute the goodwill on this date, the date when the parent company acquired the control. How do we compute that? We start by taking the cost of additional investment. The cost of additional investment. How much amount was paid by the parent company in acquiring this 30% shareholding? This 30% shareholding. This 30% shareholding. Yes, that one should be 27 because this 500 times 40%. Yes. So the cost of additional investment, this one we have it in note 1. Note 1, note 1. This is basically where we have this. Note 1. So how much amount was paid by the parent company in acquiring additional 30% shareholding? The cost is 22. 22. And then now to this, we add the fair value of the original investment. Fair value of original investment. Original investment is that 40% shareholding, and the fair value of the original investment, still we have it in note 1, sentence 2. At this date, the retained earnings was 860, and the fair value of the previously 40% interest was 3,000. That is basically the fair value of the original what? Investment. Now, if, for example, we were using now the partial goodwill method, so here we also come and we add the NCI at fair value. NCI at fair value. We only add that here when using the full goodwill method. But in our case, we're using the partial. So this will give us 5,200. 5,200. And then now to this, we need to proceed. And basically, we do what? We less the fair value of net assets acquired. The fair value of the net assets which were acquired. Fair value of the net assets which were acquired. Fair value of the net assets which were acquired automatically is something which the examiner will not give you. In most of the cases, how do we compute this one? We compute this by taking the ordinary share capital of S on this date. Ordinary share capital of S plus the pre-acquisition reserves. The reserves which S Limited was having on this date. 1st April 2019. 1st April 2019. Okay. So I've said we less fair value of net assets which were acquired. And basically, I'm saying that this one would be equal to the subsidiary company ordinary share capital. So the subsidiary company ordinary share capital, this one we have it within the statement of financial position. Let's go to the statement of financial position of S, specifically at the equity. So how much is the ordinary share capital of S? You can see that. Ordinary share capital of S. Yes, the ordinary share capital of S here is what? Is the 5,000. So then below that, we have the retained earnings. But basically, that retained earnings we know is at the end of the current year. So what we are interested with is the retained earnings on this date here. 1st of April 2019, when the parent company acquired the control. And that retained earnings, we have it in note number 1. Let's go to note number 1. Note number 1, sentence 2. At that date, when the retained earnings of S amounted to 860. That is the retained earnings on 1st of April 2019, when the parent company acquired the control, 860. So in the statement of financial position at the equity, I hope you can see we don't have any other reserve. Maybe what else do we need to include here? We need to check whether on the date of acquisition, this company revalued assets. Did S Limited revalued asset on the date of acquisition? Yes. As per note number 1, we know that this company revalued 2 assets. It revalued plant. There was a revaluation gain of 150, and also it revalued these intangible assets. And the value for that was 90. So therefore, we have a total revaluation gain of 150 plus what? Plus 90. This one plus this one. And basically that will give us what? That will give us 240. Any other pre-acquisition reserve? We don't have any other. So we get the total here. We get the total, which will be 16 and that is basically 5,000. Yes. 860 plus 240. Yes. That basically will give us 61. 61. Now, because you're using the partial goodwill method, we're interested with the net asset acquired by the parent. The net asset acquired by the parent will be 70%. 70%. But if we were using the full goodwill method, under the full goodwill method, we take 100% of this. But under the partial, we only take the net asset acquired by the parent, which will be 49 what? 70. 49.70. We less that from you're getting what? 42.70 parent. 42.70. 42.70. That is correct value. 42.70. 42 what? 70. Okay. So we less that from the amount we have here. And basically we get goodwill. We get goodwill. And the goodwill will be how much? Will be 930. 930. Also recall that goodwill is not impaired. So that basically what is required as far as that point is concerned. The marks allocated there were 4 marks. What is marked in such a case? This, that, and that. So you'll see for any 4 correct item, you get 1 mark each. So you get 4 marks there. So finally, we move to part C. So what are we required to prepare? We are required to prepare the consolidated statement of profit or loss. Okay, consolidated statement of financial position as at 31st of March 2023. Now remember what we have said that in case of a piecemeal acquisition, if you are required to prepare this consolidated balance sheet, consolidated statement of financial position, what you just need to do is to establish the status of this company at the end of the year. At the end of the year, S Limited will be what? Will it be an associate? Will it be a subsidiary at the end of the year? What will be S? S Limited will be a subsidiary. Being a subsidiary, we then do a full consolidation. Full consolidation means that we combine similar items of asset and liabilities, those of S, and those of who? Those of H. So we do a full consolidation. So we just need to have a single column here. And automatically we will start with the non-current assets. So for the non-current assets, I think we have basically a number of them. We go back to the statement of financial position for individual companies. We start with the first item of non-current asset, and that is the property, plant, and equipment. So we take that of the parent, that is H, 55.50, plus that of S, which is 42. And then we have some consolidation adjustment here. In relation to this revaluation of plant, we add 150 here, the revaluation gain. And then we have this depreciation other charge of how much? Of 100, which we said we less. From the PP. From the PP. Do we have any other adjustment affecting the PP? No. So I think we will come back and do the totals, but let's first of all, we have all the items here. So then below that, we have investment in S. Are we supposed to include the investment in S here? No. So instead, what we include here is the goodwill on acquisition of S. The goodwill on acquisition of S. The goodwill on acquisition of S is what you have computed there, 930. Before we proceed to record the non-current, the current asset, recall this company that is S Limited on the date it was acquired, there was a database of customers. And actually, we say that database of customers should be recognized as what? Intangible assets. So we have intangible asset. We should take intangible asset to those of the parent, which is 0, plus this one belongs to the subsidiary, which is 90. And basically that will be 90. Remember, no amortization. Yes. I think you have already gotten the final value for this. The final value for PP. I hope you have already gotten that. How much is that? 9,800. 9,800, like that. Okay, so we move and we record the current assets. We record the current assets. So for the current asset, we have inventory. Inventory. So inventory, we record that of the parent, 27, plus that of the subsidiary. Do we have some adjustment affecting that? Yes. Number one, we have these goods in transit, which we said we need to add them to the goods to the group inventory. So we add the goods in transit. These are goods in transit. And I think we also have unreleased profit, this one, 20, which we said we less from the group inventory. We less 20, which is unreleased what? Profit. We get the final value there. That should be 45 plus 80. 4580. Is that what you're getting? 4580. Okay. 4580, yes. So then we have the receivables. The receivables we have 3120 plus 2180. And then we have the amount of intercompany debt. This one, amount of intercompany debt of 600. So this one will be deducted there. So any amount of intercompany debt, remember, this one should be deducted from the receivables. I think we forgot to say that. And then this one, and basically that is a total of 600 million. This one will be deducted from the group payables. From the group what? Payables. We just start from the group receivables, this one from the group payables. Yes. So basically what do we get here? What do we get here? Should be 53 minus 600, which will give us 47. Then from there we have the cash and cash equivalents. We have 1130 plus 770. Any adjustment to this? No, because we don't have any cash in transit. This one is only adjusted with the cash in transit. And basically this will give us a total of 1819. 1900. 1900, is that what you're getting? Yes, 1900, 1900. Yes. So basically, no need of getting the total assets. We proceed and we record equity. So for equity, we take the ordinary share capital. And remember here, we said we only record the ordinary share capital of who? Of the parent company. Of the parent company only. Of the parent company only. So in case of cash in transit, and we add it, that one should be added to the cash and cash equivalents. So here we record the share capital of the parent company only. So the retained earnings, we say that moving forward is one of the items we will not be computing. Let's just ignore that one. Because we said even in an examination setup, we will not have time to compute these. No need of computing that. Moving forward, we will not be computing that. Because we said for these particular questions, you don't have to balance. You don't have to get everything correct for you to get all the marks. So then from there, we said there is also something else which should be computed and included there. The non-controlling interest, equally we can ignore that. Equally we can ignore that. Actually, we say these are two items I will not advise you. If you're doing this particular question in an exam, I will not advise you to compute those two items. the group retained earnings, and the NCI. So we just ignore them. And then from there, we proceed, we record what? We record the liabilities. We record the liabilities. We start with the non-current liabilities. So we start with the 10% row notes. So we take that of the parent, which is basically 18, plus that of the subsidiary. Do we have any adjustment for this? No, no adjustments. No adjustments. We get the final value. And then finally, we have the current liabilities. We have the trade payables, which is basically 15 what? 1560 plus 840. Any adjustment for this? Yes. We have amount of intercompany debt. This one, 600. We rest it here. We rest that there. And basically, this one should be 2400 minus 600, which will give us what? 1800. 1800, is that what you're getting? Yes, 1800. Finally, tax. Now, there is something I think I mentioned in our previous class. Anytime you come across a question for group account, and there is a component of tax, whether it is in the income statement, whether it is in the statement of financial position, this one is always pre-marked. No single time you'll be told an item for tax is to be adjusted in any question for group account. Sasa? Yes, tax, whether it is in the income statement, because even here you may have deferred tax, always these are pre-marks. We just need to add 350 plus 200 and what? 50. And that will basically give us what? That one will give us 600. That one will give us what? 600. That one will give us 600, 600. So that question, if basically leave it at that point, even without computing those items, you'll basically be able to get all the marks. You'll be able to get all the marks, because in most of the cases, in terms of how this question will be marked, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. In most of the cases, this is how the question is marked. Any 7 at 2. You need to get 7 items correct. For every correct item, you are allocated how many marks? You are allocated 2 marks. Yes, so the whatever we should rest here from the payables should be 600. Should be 600. Sasa should be 600. 600, not 500. Because in this 500, this amount was not included. Remember this amount, which we said we are going to add to the payables? That one was not included here. That's why we added that in relation to the goods in transit. In relation to the goods in what? In transit. In relation to the goods in transit. Yes, yes. So that basically what was required as far as that question is concerned. And I've said it's not a must. You get all the marks, because mostly this is how the question will be marked. Was actually marked, that is. Any
Now, August 2025, question 1C. Not 1, question 2C, sorry. Question 2C. The question reads, assume that you have just won a competition prize with the following options. Assume that you've just won a competition prize with the following options. Option A, lump sum payment of shillings 25.8 million in 5 years' time. With lump sum payment of shillings 25.8 million in 5 years' time. Option B, a sum of shillings 1.6 million paid as follows. Oh, that is 16 million, sorry. A sum of shilling 16 million paid as follows. We have shillings 5 million payable today. Today means now 5.5 million to be paid after 1 year, 5.5 million to be paid after 2 years. And that should add up to 16 million shillings. Option C, annual payment of shillings 1.4 million for 30 years. We are saying annual payment of shillings 1.4 million for 30 years. The first payment being made at the end of the year. And next, a perpetual payment of shillings 1.38 million. Required, assuming a required rate of return of 8%. Advice on the payment option that you would select. Assuming a required rate of return of 8%, advice on the payment option that you would select. So here now, you're supposed to understand whether you're supposed to do discounting or you're supposed to do compounding. Because here the question says, assume that you've just won a competition prize with the following options. Option 1 is saying a lump sum payment of shillings 25.8 million in 5 years' time. That is, you'll be paid 25.8 million after 5 years. The other one, option B, they are saying a sum of shillings 16 million paid as follows. The 16 million is not being paid immediately or in lump sum, but they have broken down the 16 million into 3 payments. Then we have option C, annual payment. That's an annuity of 1.4 million for 30 years. The first payment being at the end of the year. And option D, a perpetual payment of shillings 1.38 million. So this question is testing on all the concepts that we've talked about. Present value of a lump sum, present value of an annuity, present value of an annuity in perpetuity, and all that. So that is why I'm saying, unless you've understood the concept of time value of money, discounting and compounding, you may not be in a position to answer some of these questions. And you see, that is a total of 7 marks. 7 marks, and this is how you are supposed to do that question. So we start with the option A. Or in short, before we start doing the question, I said you cannot compare figures which are not in the same period. You cannot compare figures which some are in period 2, others are in period 3, others after 5 years. For example, option A, we are told that the payment will occur after 5 years. Option B, we are told that the payment will occur several times, a number of payments. Option C, it is an annual payment. It is an annual payment. And option D, it is still perpetuity, an annual payment, an annuity that will be done till perpetuity. So, as I said, you cannot compare amounts which are occurring in different periods. For example, we are here today, now. Then we have 25 years to come. Then we have perpetuity. Then we have some other periods here. We have 5 years. You cannot compare amounts which are being paid or received in different periods. What you're supposed to do, it is to bring them to present value. Bring all these figures to present value. Bring them, all of them, to present value so that you can compare the figures at present value, in present value terms, and advise the investor accordingly. So the first thing, it is to bring the figures to present value and choose an option that provides us or gives us the highest amount in present value terms. You choose an option that gives us the highest amount in present value terms. That is what you're supposed to do in that question. So let's start with option A. Let's start with option A. Option A, a lump sum payment of shillings lump sum. A lump sum payment of shillings 25.8 million, which will be paid after 5 years. N is equals to 5 years. Remember what we said? Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is equals to the lump sum. Present value of a lump sum is equals to the future value times, let us use the tables. Let's use the tables. Times, but we said 1 plus r power negative n, which can also be written as future value is equals to present value interest factor r% power n. So in this case, we will have our 25 million times present value interest factor. Our r is 8%. Our r is 8%. So you say 8% power 5. 8% power 5. So this will be 25.8 million. Then you read this factor from the tables. Read 8% at period 5 from the tables. And you save time. You save time. I'm waiting for 8% at period 5. Yes. You do not have the tables? May I have the tables, but I want you to read. I want you to give me the factor. Like now what Alan has done. Alan, that is wrong. Alice, that is wrong. That is what I wanted. That is actually what I wanted, because this is a lump sum. This is a lump sum. So we are using the upper table, present value interest factor tables. This is a lump sum. What you're giving me is for an annuity. Yeah. So Edith, yours is 0.6806. Let me check. Yeah, that is right. 0.6806. We said a lump sum is that a payment. It's a payment or a receipt which occurs once. Like in this case, this person will be paid 25.8 million once after 5 years. After 5 years. That's why we are using this factor, because it is a lump sum. So multiply, get the answer. Multiply. You're taking too long. 17.55. 17.55 948 million. That is option A. Option B. Option B says what? Option B says a sum of shilling 16 million paid as follows. A sum of shilling 16 million paid as follows. So here, option B. We'll have year, amount, discount factor, you're using 8%, present value. So the first one, we are saying a sum of shillings 16 million paid as follows: 5 million payable today. Today is year zero. 5 million. 5 million shillings. Then 5.5 million paid to be paid after 1 year. After 1 year, they will receive 5.5 million. Next, 5.5 million to be paid after 2 years. So after 2 years, 5.5 million. This is what you're saying. If we can illustrate here, this is year zero, or not, this is now. This is in present value terms, today, present. Then we have year one, and we have year two. 5 million will be paid here, 5.5 million here, and 5.5 million here. That's what we're saying after 1 year. After 1 year, 5.5 million. After 2 years, this one and this one, 5.5 million. So here, the discount factor at present, at year zero, the present value interest factor is 1. Or rather, the factor here is 1. It is in present value terms. And that is what we are looking for. So here we will have 5 million. How about 8% at period 1, 8% at period 2? Note, just a minute. This is an annuity. This is an annuity. I will show you 2 ways of doing this. So but let's start with this. Use the upper table to get these figures here. Use the upper table to get this. Don't take too long to read these factors from the tables. And I want you to read for yourselves so that you can make mistakes and we correct those mistakes. So what is 8% at period 1? 8% at period 1. $0.9259. 0.9259. Year 2. 0.85. 8573. So we multiply now. We multiply. So this is 5.09245. The other one is 8573. That is 4.715. 4.71515. So then the amount here, the total amount here should be, so plus 5.09245 plus 5, 14.8076. 14.8076. That is the first way of doing that question. Or Remember, this and these are annuities. The 5.5 million is an annuity because they are following each other. So here you can say this, or amount is the 5 million times 1, because that is in present value terms, plus 5.5 million times present value interest factor annuity, 8% at period 2. 8% at period 2. So that will be, this is 5 million plus 5.5 times, we read 8%. So give me this factor. Give me this factor. %, present value interest factor annuity. Present value interest factor annuity, 8% at period 2. There are two ways. I'm showing two ways, Akinyi. I'm going to explain this. So like now, Edith, you've got it wrong. It's 1.78. 8% at period to 1.7833. So multiply, see whether you're going to get the same answer as what we have above there. So this will be 5 times 5.5 times 1.7833. How much are you getting? Yeah, 14 points. Almost the same, 14 points. 14 points. 80815 million. So which is almost the same. So please note, when you're given cash flows like these ones, year 1, 2, 3, and 4, cash flows or amounts, you're told 100, 10,000. Let's go with 10,000. 10,000, 10,000, 10,000, 10,000. This is an annuity, but you can still use the upper table. You can still treat them as lump sums. Shadrach, yours is 14, or you're dealing with what? Millions. So I'm saying, and this is, I'm answering Akinyi. Akinyi, we're saying these are annuities, but you can still use the upper table to get the present value of this by having the factor at period 1, the factor at period 2, at period 3, and at period 4. However, there is a shortcut. There is a shortcut whereby you will say 10,000 times present value interest factor annuity R% power 4, this 4. That is a shortcut. But you can still treat them as lump sums and get the present value of each, like what we've done here. Is that clear? So annuity starts at year 0. Alan, what are you saying? Alan, annuity starts at year 0. Yeah, and ends at when? But we are told the amount is being paid at the end of year 1. Yeah, Alan, I'm saying it starts at it's being paid at the end of year 1. Here, remember, we talked about annuities that are paid at the beginning of the period and annuities that are paid at the end of the period. If we were told that the amount will be paid at the beginning of each period, it would have been an annuity due. It would have been an annuity due. But in this case, we've been told, let's go back to the question. It's also important to recheck. They're saying, a sum of shillings 16 million paid as follows. Shillings 5 million payable today, and today we have said this is year 0. Then 5.5 million to be paid after 1 year. So if you from today, you're being paid after 1 year. That means it is at the end of year 1. And the other one, 5.5 million to be paid after 2 years. So Alan, I believe that's okay. Okay, let's continue. So now you've seen the two ways of doing that question. Make sure you, and that is why I'm saying you have to understand. You need to understand. You don't need to just cram. No, you need to understand why this method is the same as this. If you had this and this plus this, it will give you this. Can you try this plus this? These two factors here, 0.925 plus 0.8573 must be almost the same as this factor. Because the annuities, we get annuities from the present value interest factor table. These things are related. They are related. I don't know. Let me check. Are you adding 0.9259 plus 0.8573? Yeah, almost the same. So that's why, because if this plus this is equals to this, then that's why we are picking just this and multiplying with this. So let's continue. Kindly, if you have a question, just ask. I want you to understand. Option C, annual payment of 1.4 for 30 years. For 30 years. Option C, this is annuity. That's an annual payment is an annuity. Of shillings 30 million? No. Of 1.4 million. 1.4 million. The period is 30 years. The period is 30 years. Our R is 8%. Then the first payment being made at the end of the year. The first payment being made at the end of the year. Now, look at this. This is a very good example, actually. Now, we've said here that you can either, no, let's come back here. We have 1, 2, 3, like in this case now, we're saying 1, 2, 3, 4, 5 for 30 years. For 30 years. And each year, they are paying 1.4 million. So what are they saying? 1.4 million each year. 1.4, 1.4, 1.4, 1.4, 1.4 up to 30 years. And we have said you can still treat this as lump sums and use the upper table to get the present value of this. But do you think that will consume a lot of your time? 30 times, 30 years, from 1 to 30. Then you multiply by each factor. Like in this case, you multiply, then you get the summation. That is a lot of work. That is tedious. That's why we're saying when it is an annuity, you do not need to use the upper table. You just get that figure, that annuity figure times the present value annuity factor. So here you'll say present value of annuity is equals to the annuity times present value interest factor annuity R% power N. Another important factor, another important thing in this question is we are option C, that is. In option C, we have been told that the payment will occur at the end of the period. The first payment being made at the end of the year. At the end of, so this is an annuity that occurs at the end of the period, not at the beginning. So here you'll say 1.4 times present value interest factor annuity, 8% power 30, because our N is 30. So read 8% at 30 years. Annuity. And kindly if you're having a challenge, make sure you revisit these things or you ask. I want someone to read 8% at period 30, 11.2578. So the total amount multiply by 1.4. At least multiply by 1.4. $15.76 092 millions. And if you have a question, feel free to ask. Feel free to ask. Option D. Option D. Option D says a perpetual payment of shillings 1.38 million. A perpetual payment, that's an annuity first. That's an annuity of shillings 31.38 million. Period N is perpetuity. Remember how we get the present value of an annuity in perpetuity. Present value of annuity in perpetuity is equals to the annuity. You divide by what? R. So our R is 8, bado. R is 8%. So 1.38, you divide by 0.08. You divide by 0.08. So how much are you getting? $17.25 million. 17.25 million. Any question? Any question? Before we proceed? I want people to ask questions. Yeah, the table is always provided. The table is always provided. Both the present value interest factor table and the annuity factor tables. I don't know whether you can see here. This is an exam paper. You can see here, these are the tables. They are always provided. But you also need to be able to compute using your calculators. You should also be able to do using your calculators because you can be given a factor, a percentage, a rate that is not in the table. For example, if you look at the table, there is no 17%. So if someone wants to bother you, they'll say 17%, and maybe it's not in the tables. Or 11, is 11 there? 11 is not there. So you should be able to compute using your calculators. For the annuity factor table, or rather, for annuities, we say it is 1 plus R power negative N over R. That is for annuities. For interest factors, like in this case, which one? This one. Here we said it's 1 plus R power N. We get the same factor as when we are using the tables. It is always important to use the table, Alan, to minimize chances of making mistakes. To minimize chances of making mistakes, you'd rather go for the table rather than using the calculator. Because you see, if you mess with your calculator, you are done. So it's always important to use, I recommend the tables when the rate is there. So I want us, or we want to advise. No, you have to say something. You have to say something. We said we go for the option that provides the highest amount. Option A, it's 17.5 million. Option B, it's 14 million, 14.8 million. Option C is 15.76 million. And option D is 17.25 million. So we go with option A. So we go with option A. The question was, assuming a required rate of return of 8%, advise on the payment option that you would select. So just say, I would select option A. I would select option A. I would select option A because it provides the highest amount, because it provides the highest amount in present value terms, because it provides the highest amount in present value terms, in present value terms. Is that okay? Okay, fine. Another question. Another question. So how was this question? Was it challenging or it was a straightforward question? The way you can see it. Yes? Okay, let's look at December 2023, question C and D. December 2023. December 2023. Question 3, C and D. Question 3, C and D. So December 2023. We start with question. No, we will not do C first. There is a bit that you're supposed to look at. That should be our next thing, the loan amortization. Let's look at question 3D. 3D. So that's December 2023. Question 3C is what we will do next. Are you there? The question reads, 𝐎𝐍𝐋𝐿 has the following investment options to choose from. So this person has the following investment options to choose from. Post office MIS scheme, monthly interest 8% per annum. Monthly interest 8% per annum. Next, ICD bank deposits, quarterly interest 8.25% per annum. HDFC Limited, half yearly interest 8.5% per annum. Required using effective interest rate method, advise 𝐎𝐍𝐋𝐿 on the preferred investment option. On the preferred investment option. So this is multi-period compounding and discounting. So you remember we talked about the effective interest rate, yeah? So effective interest rate, this is December 2023. Question 3C. Effective interest rate, we said is equals to 1 plus R over M power M minus 1. Power M minus 1, whereby we said power M is the number of times compounding occurs in a year. The number of times compounding occurs in a year is what we call in M. So now here, we start with the first one, post office MIS scheme. Post office MIS scheme. The interest rate here is 8% per annum. The payments here, it's monthly interest. So our M is 12. So effective interest rate is equals to 1 plus 0.08 over 12 power 12 minus 1. So how much are you getting? The effective interest rate for post office Someone give me the answer, kindly. Save time, save time. You have a number of things to do. So 0.08299, call it 0.083. So this is 8.3%. 8.3%. That is for the post office MIS scheme. Next, ICD bank deposit. The rate is R is 8.25% per annum. This is quarterly. Our M is 4. So effective interest rate is 1 plus 0.0825 over 2, not 4, over 4 power 4 minus 1. Whatever answer you get, multiply by 100. %8.51%. 8.51%. So we are multiplying by 100%, whatever answer we are getting. And next, thank you for your answers, Alan and Stephen. HDFC Limited. Here, interest is half yearly, but 8.5% per annum. 2, and then effective interest rate, which is 1 plus 0.085 over 2 power 2 minus 1. %8.68%. Any question? Okay, now before any question, advise 𝐎𝐻𝐂𝐔𝐒 on the preferred investment option. Advise this person on the preferred investment option. Remember, the question says, 𝐎𝐻𝐂𝐒 has the following investment options to choose from. This is someone who wants to invest. This is someone who wants to invest. So which investment option is better? The one that provides the highest rate is what we are supposed to adopt. That is option C, HDC. HDFC. So they're saying advise this person, advise 𝐎𝐻𝐂𝐒 on the preferred investment option. Say the preferred investment option, is HDFC Limited, since it provides the highest rate of return, since it provides the highest, say, effective interest rate. It provides the highest effective interest rate. The highest effective interest rates. Okay, fine. Now you can see there are questions from this topic of time value of money, and like I've said, you cannot handle these questions unless you get the concept. And I said, ensure you write your formulas every time you're doing these questions for you to be able to remember. So we will do more illustrations as we continue. So, but now, for now, just write loan amortization. Loan amortization. Loan amortization. Loan amortization. Loan amortization. Now, when you talk about a loan amortization schedule, Mwalimu, half yearly, should it not be 6 months? Yeah, and 6 months should be 2 years. Not 2 years, but 2 semi-annually. 2 halves, semi-annually. So you cannot use 6 months here. Whatever breakdown you're providing should add up to, it should add up to a year. Are we together, Stephen? You cannot use 6 months. You only need to divide. It's like upper to member quarterly. Quarterly we said 4, because in a year we have 4 quarters. Same case, we have 2 halves in a year. Yeah, so that is the case. So loan amortization schedule or loan amortization. Loan amortization, this is like, for example, loan. We're talking about loan amortization. If you acquire a loan from a bank or from any financial institution, we have the loan amount. The loan amount, let's say you've acquired a loan of shillings 1 million. This loan is payable after a period of 5 years. And this loan, you'll be charged an interest of 12% per annum. So what the loan amortization does, it helps us to understand how much should be the installment payable for this loan to be exhausted in a period of 5 years. So remember, when you acquire a loan, the repayment that you make must be it's the principal. You will pay the principal plus the interest charged, the total amount that you borrow. You borrowed 1 million, so that is 1 million is the principal, but you are going to repay the 1 million plus an interest amount that we don't know. Here you say X. That is the total amount payable at the end of the period. So, but we are asking ourselves, now that we've given this person a loan of 1 million shillings, payable within a period of 5 years, at an interest rate of 12% per annum, and whereby in repayment or in return, this person is paying a principal plus an interest amount. How much of an installment should this person pay within this period of 5 years to have exhausted, or rather to have exhausted the total amount within a period of 5 years? So I'm saying the loan amortization schedule helps us to determine the amount of installment payable by a borrower to the lender to exhaust a loan amount within a given period of time. Now, this one is very simple. The loan amount, because you're getting the loan today, you're getting the loan now. The loan is in present value terms. The loan is in present value terms. Then we have the installment. The installment, remember, they are equal installments paid within a regular period of time, or rather paid regularly. If it's monthly, monthly. If it's quarterly, quarterly. If it's semi-annually, if it's yearly. But an installment, it's a constant figure. So an installment is an annuity. An installment is an annuity. So with the present value here and with an annuity here, then it becomes very easy to determine what? It becomes very easy to determine to determine the installment payable in a loan. So this is what we do. We remember what we said. We said present value for lump sum, no. Present value for an annuity. Present value of annuity is equals to the annuity. Is equals to the annuity times present value interest factor annuity R% power n. That is what we said. So, but now we are saying the loan that you borrow is in present value terms. So this becomes the loan amount because the loan amount is the present value of the installments that you're going to pay, while the installments here become the annuities, or rather the annuities become the installment. That means if you want to get the loan amount with the installments, you can get the present value of the installment. The present value of the installments must be equal to the amount of the loan that you acquired. Yeah? I don't know whether we are together. I'm saying the present value of installments, the present value of the total installments that you are paying within the repayment period must be equal to the loan amount. So like in this case, whatever installments that we will have here, let's say like the installment is, let's say like it's a monthly installment, and we say 30,000 per month. So we are saying if you get the present value of these installments, they must be equal to the loan amount. And that is what we have here. So have this, write loan amortization, then you write this formula. And if you have a question, please ask. Don't shy to ask questions. The definition of a loan amortization, it's just a schedule of depleting a loan. So, but you can say a loan amortization schedule, shows the interest charged, shows the interest charged for each period, shows the interest charged for each period, comma, installments paid, and the balance outstanding, at the end of each period, at the end of each period. So in short, a loan amortization schedule, this is a schedule that shows how you are depleting your loan balance. Remember, the interest is charged on reducing balance basis. If the interest is being charged on reducing balance basis, it will show how you're depleting your loan balance, and the interest that you're paying in each period, and the installment. Again, this installment that we've talked about here, like this 30,000, it is not that you first pay the principal amount, then you start paying interest, no. Or you pay the interest first, then you start paying the principal amount, no. What you do, each installment as an element of the principal amount and an interest. Each installment that you're making consists of two things, a portion of the principal amount and a portion of the interest charged. So you pay together until you exhaust the loan. Let's look at an example. April 2024, question 4C. April 2024, question 4C. April 2024, question 4C. So let me write here. April 2024, question 4C. And like I've said, do not shy to ask questions. This one is very important. April 2024, question 4C. So a company negotiates, the question reads, a company negotiates a shillings 30 million loan for 8 years from a financial institution. The interest rate is 14% per annum on the outstanding balance of the loan. The principal and interest will be repaid in 8 equal year-end installments. Required, prepare a loan repayment schedule. And 2, determine the amount of interest payable at the end of the 8th year. So let's look at that. And please make sure you follow. Make sure you follow. So we are saying a company negotiates. So this is April 2024. Question 4C. A company negotiates a shillings 30 million loan. So loan amount 30 million. 30 million. Then the interest rate is 14% per annum. 14% per annum on the outstanding balance of the loan. On the outstanding balance of the loan. The principal and interest will be repaid in 8 equal year-end installments. So the period here is 8 years. The principal and interest will be repaid in 8 equal year-end installments. Required, prepare a loan repayment schedule. So before, you cannot, the first thing, it's to determine the installment amount. You cannot prepare the repayment schedule if you don't know the installment amount. So we should start by getting the installment amount. Then after that, we prepare the repayment schedule. So, like we have said, you say loan, now present value of an annuity, present value of annuity is equal to the annuity times present value interest factor annuity R% power n. So we have said this is the loan amount, while this is the installment. This is the installment. So we say our loan amount is 30 million. Let's just have the whole 30 million here. 30 million is equals to installment times present value interest factor annuity 14% at period 8. 14% at period 8. 14% at period 8. So here we said that we are supposed to make this the subject. We are supposed to make this the subject of the formula. But before that, let's say 30 million is equals to installment times, read this factor from the tables. Read this from the tables. 14% at period 8. 14% at period 8 is how much? 14% at period 8. 14% at period 8. Someone kindly. 4.6389. 4.6389. 4.6389 is the factor, 14% at period 8. So remember, this is an annuity, eh? We are referring the installment, we've said it's an annuity. That's why we are using the annuity factor tables. 46389. So then we divide both sides by what? This figure. So over 4.6389 over 4.6389. So this will go So installment is how much? Installment. So divide yes. 64, 67, 64, 67, 050, 050 points, let's say 38.38, 64, 67, 050.38. That is the installment. After getting the installment, now we can prepare the amortization schedule, the repayment schedule. So loan repayment schedule. Loan repayment schedule. So here we have period, amount due. Now let's say balance brought forward. Balance brought forward. This is balance brought forward. Here we will have interest. Interest is charged on the balance brought forward. We are charging interest at 14%. Here we will have the installments. Here we have the installments. And here we have the balance carried forward. That is at the end of that period. The balance carried forward at the end of that period. So we have period 1, we have the balance brought forward. So here we have period 1, 2, 3, 4, 5, 6, 7, 8. We have 8 periods. Then we have 8 installments. Now before that, how much have we borrowed? We borrowed 30 million. 30 million. 30 million is what we've borrowed. So let me do some spacing here. Let me do some spacing. So balance brought forward is what we've borrowed. So here we will charge interest at 14%. Here we will make our installments. And here we have the balance carried forward. Yes. So period 1, the balance brought forward is 30 million. We will charge interest on that. Then we will also pay installment at the end of period 1. We are going to pay an installment. After we pay an installment, there will be a balance. So say this is A, this is A, this is B, this is B, this is C. So this is A plus B minus C. The balance carried forward is A plus B minus C. Remember, the installment reduces the amount of the loan, but interest increases the amount of the loan. Now, here the installment is 64, 67, 050.38. Remember, the installment remains the same till the end of the period. So we will have 8 installments of this figure. So let's have 64, 67, 050.38, 64, 67, 050.38, 64, 67, 050.38, 6467 050.38, 6467 050.38. That's the sixth installment. 6467 050.38, and the last one 6467 050.38. How do you know that you are correct? The last installment should exhaust the loan balance. So here, when we make the the eighth installment, it should exhaust our loan. So here we will have nothing. Here we will have nothing. So let's start now. I want to believe you have that. Do you? I want us now to start doing the repayment schedule. Okay, fine. Let's proceed. Let's proceed. So the first one, for period 1, we are charging interest on 30 million. Charge 14% of that million for 20. This is 4.2 million. 4.2 million. Here, we're saying 14% of that million, 4.2 million. 4.2 million is the amount of interest charged in period 1. So this plus this minus this, we get the balance carried forward. This plus this minus this, get the balance carried forward. So this is 30 million plus 4.2 million minus 6467 050.38. I'm getting 27 732 949. Yes. 27 732 949.62. The balance carried forward at the end of period 1 becomes the balance brought forward in period 2. So this is 27 732 949.62. Charge interest again 14%. I'm getting 3882 612.95. 612.95. Yeah. Then plus the balance brought forward 27 732 949.62 minus our installment 6467 050.38. I'm getting 25 148, and kindly relook at these figures. 25 148 512.18. That should be 7. Eh? No, that's okay. Are you getting the same? Then here the balance should be 25 148 balance brought forward, 148 512.18. We charge interest on that. Charge interest on the balance brought forward. Which is 35.20. The interest charged 35.20. 35.20. 35.20. 791.71. 35.20. 791.71. Then plus the balance brought forward 25.1, 48, 512.18 minus 64.67, 050.38. I'm getting 22, 202, 253.50, which becomes our balance brought forward here. 22, 202, 253.50. Then times our interest again, we charge interest. Get 31, 08, 315.49. And 22, 202, 22, 202, 253.5. Minus the installment, 64.67, 050.38. So 18, 843, 518.61. So here we have 18, 843, 518.61. Then we charge interest. $26.38, 092.61. Then plus the balance brought forward, 18,843, 518.61 minus the installment, 64.67, 050.38. So this is 15, 014, 560.83. 15, 014, 560.83. Then we charge interest. 2102, 038.52. And I believe you are all doing this, because if we get it wrong somewhere, then it will not be good for us. 10,649 is the balance here. 10,649, 548.96. 548.96. That is the balance brought forward here. 10,649, 548.96. Then we charge interest on that figure. We get 1490, 1499.36.86. Add to a balance brought forward 10, 649, 548, 10, 649, 10, 649, 548.96 minus the installment 6467 050.38 5673 5673 435.44 5673 435 5674 435.44. So 5673 435.44. Then times 14%, 794 to 80.96. 794 to 80.96. 56 73 435.44 minus 6467 050.38. We're getting a balance of 666. That is because of rounding off. That is because of rounding off. So that should be okay. Any question? So yes, Alan, I'm getting the same, a balance of 666, which should be attributed to the rounding off effect. So that means the last installment, okay, the bank will know how to recover the 666. So, but that is what a loan repayment schedule looks like, or a loan amortization schedule. Any question? Any question? Any question? Okay, you can even write the 000. But yeah, you can put the 666 there. Still okay. You can also put the 0. Still okay. The most important thing is how you've been able to tabulate all this. Yeah. So you can do the 666 there, because the bank will recover that amount maybe the following month. You can do 666. But my intention was to show that after the last installment, we should have exhausted our loan balance. Now, we have part 2 of that question. Determine the amount of interest payable at the end of the 8th year. Determine the amount of interest payable at the end of the 8th year. This one. This is the amount of interest payable at the end of the 8th year. At the end of the 8th year. So interest payable at the end of the 8th year, it's 794 to 80.96. Interest payable at the end of the 8th year, 794 to 80.96. Any question? Okay, another question. December 2023, question 3C. December 2023, question 3C. December 2023, question 3C. So allow me to do away with this. Or we can maybe look at this first. No. Has everyone written this? Just let me do away with this. So we have an investor plans to borrow a loan of shillings 3 million to purchase a piece of land for his family. The interest rate agreed upon is discounted at a rate of 10% per annum. The loan is repayable in 4 years of equal installments. So 4 equal installments. Required amount payable per installment and a loan amortization schedule. So the loan amount is 3 million to purchase a piece of land for his family. The interest rate agreed upon is 10% per annum. 10% per annum. The loan is repayable in 4 years of equal installments. 4 years. Then amount payable per installment. Like we have said, present value of annuity is equal to the annuity times present value interest factor annuity R% power n. So we have said this is the loan amount, this is the installment, this is the installment. So 3 million is equals to installment times present value interest factor annuity 10% at period 4. So 3 million is equals to installment times. So the factor here, 10% at period 4. 10% at period 4, we are using the lower table. 10% at period 4 should be 3.1699. 3.1699. So then you divide both sides. 3.1699. 3.1699. So this and this will go. So installment is equals to so this is 3 million divided by 3.1699. 3.1699. You get 946. 946. 402.09. 09. That is the installment. I want to believe you are getting the same answer. Are you getting the same? Are you getting the same answer as me? Thank you, Edith. Let's have the loan amortization schedule. At least this one is shorter. So this was part 1. Part 2. Loan amortization schedule. Loan amortization and loan repayment schedule, the same thing. So again, we will have the period here. We have 1, 2, 3, 4. We have the balance brought forward. We have interest at 10%. We have installments. We have installments. And we have balance carried forward. And balance carried forward. So we borrowed how much? 3 million. We are paying an installment of 946. 402.09. So we start charging interest. We are charging interest at 10%. So the first period it will be 3 million. 3 million. Then what is the balance carried forward? It is 3 million plus. Hey, this should be 300,000. 300,000. 300,000. So 33. 3.3 million minus the installment 946, 402.09, 2353, 2353, 2353, 597.91. So 2353, 597.91. Charge interest on that at 10%. It's 235. 235, 359.79. Oh, the installments, you said these ones remain the same. So you just write them. Two 359.79 plus the amount brought forward 23, 53, 597.91 minus the installments 946, 402.09. So this is 1642, 555.61. 1642, 555.61. Then we charge interest on that at 10%. It's 164, 255.56. 156. So 1642, 555.61 minus 946, 402.09. So 860, 409.08. 860, 409.08. So then interest we charge at 10%, 86, 860, sorry. No. Yeah, 86, 040.91. So that's minus the installment, we should get 0. 860, 409.08 minus 946, 402.09. So we have a balance of 47 shillings. 47. Let's say 48 or 47.9. So we are together. Any question? You people, you're not asking questions. Okay, fine, Akin. There are a number of questions for loan amortization schedule in the past papers. Ensure you go look at them. Go look at those questions on loan repayment schedule and other topics, or not other topics, but other time value of money questions that you have in the past papers. So this should bring us to the end of this topic. This should bring us to the end of this topic. And as I said, this is a very key topic in financial management. And that is why I did not want to rush. I wanted to ensure you all understand the concept of time value of money, compounding and discounting. Yeah. So I don't know whether you have any question or any objection before we close this topic. You've seen the concepts, like the first question that we did for August 2025. It was a very good question. At least we explored what we had learned on lump sums and annuities in perpetuity and that. So, any question? Oh, it was not uploaded. Okay, I'll follow up. Let me follow up, Catherine, and I'll ensure the same has been done. Oh, this one should be uploaded by tomorrow. Tomorrow it should be uploaded. Any other question? Please ensure you do practice. Do a lot of practice on these questions. Reach out whenever you have a challenge so that we can address it together. These are things that you can easily forget. And financial management questions are very short, but they can really trouble someone. You can see like a two-statement question that can bother you until you feel bothered. Like if you look at most of the questions in financial management, they are very short questions. And you should always be afraid of the short questions. The short questions are the most difficult questions because the information is hidden. So, but that is not to scare you. Once you get the concept, you can be able to tackle all the questions. So with that, let's call it a topic. Let's call it a day. See you on Wednesday. See you on Wednesday. We start another topic, that is valuation of securities, and I will be good to go. So whatever we have learned here under the time value of money, we are going to use it in our next topic. So make sure before we meet next time, you have gone through all that we've learned under the time value of money. It will be helpful for you. So with that, have a good night. See you on Wednesday. No problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this, it may be if you determine if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you are supposed to compare the two, you cannot compare when they are not in the same form. You are supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So We start with future value of a lump sum. Now, when you talk about the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, that there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annual. Determine the future value of the investment after 3 years. N, we should have said N here, N. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity, you get the annuity amount times annuity amount times, so we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout, okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate, and it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. an investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 16,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. $322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period. Period. 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 16. 16. 16. 16. At the end of each period, this person is investing 60. So here you say 1 plus r power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus r, 1 plus r, this is 0.2, 0.2, 1 plus 0.2, 1 plus 0.2, 1 plus 0.2, 0.2, 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call, okay, fine, Alice, 080, okay, fine. So, future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that we invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what gets us for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they're saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus R power n minus 1 over R times 1 plus R. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year one. So we are saying this first 100,000 that was invested at the beginning of year one, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. On 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut, but we are doing this method so that you can get the concept, because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting, or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R percent power n. Present value interest factor, R percent power n. So let me share with you the present value interest factor tables. Just check on your WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting, I have shared. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one we're going to do in an illustration. So what do you need to add here? Nothing. So when we are using tables, we say present value of a lump sum with tables. You say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equal to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using, that is, using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we are together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for end periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there at 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what we are supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equal to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equal to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay for that project if the required rate of return is 10%? So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025 paper. Which question? Question 4A. Not sorry, not that one. Now, yeah, question 4B. question 4B. Question 4B, if you're there, you will see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay, we say maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if it's a share, to get the maximum price to pay for a share, it is the present value of all expected dividends from that share. If it is an asset, like for example, you want to buy a motor vehicle for commercial purposes, the maximum price that you're supposed to pay for that motor vehicle, it is the present value of all what you're expecting to earn from it. So that is what this question says. So back to the question. So what I'm trying to say is that some of these things you don't need to forget. Like I'm sure this is something that I repeated a number of times last semester. And you see it came in the exam. So maximum price to pay, kindly note, because it's a concept that will keep on applying. Back to our illustration. So they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. Annuity is shillings 1,000. Number of periods is 4 years. 4 years. And they're saying, what is the maximum amount would you be willing to pay for that project if the required rate of return is 10? R is 10. R is 10%. So maximum price to pay, this is present value of annuity. This is the present value of our annuity. So present value of an annuity, is equals to the annuity times 1 minus 1 plus R power N over R. So our annuity here is 1,000 times 1 minus 1 plus 1 minus 1 plus 0.1 power negative 4 over 0.1. So shillings. Get the figure. How much are you getting? That 169.87. That 169.87. Another person. That 169.87. Another person. That 169.87. We are waiting for another answer. Someone else kindly. Okay, let's assume that is the correct answer. Or present value of annuity is equals to annuity times present value interest factor annuity R% power n. So here 1,000 times present value interest factor annuity 10% at period 4. 10% at period 4. So 1,000 times. So now let's go back to the tables. Let's go back to the tables. So thank you, Tambua. Back to the table. We are using the lower table now. We are using the lower table now because this is an annuity. Go to 10%, drop up to period 4. Go to 10%, drop up to period 4. 10% to up to period 4, we have 3.1699. Oh no, just give me the factor. 10% at period 4 in the lower table. So I'm saying 3.1699. 3.1699. So you can see we are getting the same thing. That 169.9. That 169.9. I want to believe you've all been able to read the table. Yeah. Okay, fine. Next, we look at present value of annuity due. That is next time. We'll pick from that point next time. Number 3, present value of annuity due. Present value of annuity due. I believe we'll be able to look at all the factors, then we proceed to something else. Now, as I said, this is very important. Make sure, and that is why I don't want to rush. I do not want to rush because this concept is very important. If you get it at this point, you will have no problem going forward. You'll be very much okay. So make sure you repeat these concepts, do the illustrations that you've done. In case of any question, you will ask. Any question for now? Any question before we close? Any comment before we close? Yes? Okay, fine. If no question, we are going to close at that point. See you on Saturday. See you on Saturday. And enjoy, or rather have a good night. Have a good night. Check whether starter class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this it may be if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of this 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money. Introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus R power n. Principal times 1 plus R power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus R power n. This factor here, this factor 1 plus R power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus R into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value
here. I want us we just do this. Maybe the one which is do not have a lot of work. A question you should be able to finish within time. Within the time we have. Let me see, we have this one. We also have this one. Yes, I think let's prepare this one. I think this one is quite simpler. Yes. Let's not quite simpler is we will be able to finish this one within a short period of time. Yes. Now we are given this particular question here, and basically what are we told? We are told Mr. 𝐅𝐻𝐒, an audit assistant, has been trading. Okay. Mr. 𝐅𝐻𝐒, an audit client, not assistant, audit client, has been trading for several years. He has provided you with the following list of account balances as at 31st of December 2022. So these is basically a list of balances. So we have capital revenue, payable, return outwards, expected credit losses, discount which was allowed, and then we have discount received purchases, return inwards, distribution cost, drawings, rent, rates and insurance, writing and heating, postage, telephone, postage, stationary, telephone, advertising, salary and wages, credit losses, cash in hard cash at bank, inventory. We have receivables, we have property, equipment and furniture at cost. We have accumulated depreciation, and then we have depreciation for the year. Then we are told, as you begin the audit process, you discover the following adjustment that should be made to finalize the financial statement as you carry out the substantive test. Remember, substantive tests, these are basically the detailed audit tests, which are basically conducted in course of the audit. So you have discovered the following adjustment. We have crossing inventory. We have prepaid insurance, right, heating and lighting, which is basically accrued, prepaid rates, and then we have the expected credit losses, and then you're given some errors or omissions which were identified. An invoice for goods sold was not posted, drawings of goods not reflected in the drawings, and then we have an additional credit losses omitted of 220,000. Depreciation expense for the year is understated with an amount of how much? 120,000. So based on that information, what you're required to do is we prepare an audit schedule with 8 columns with the following headings: the original trial balance without adjustments, the draft statement of profit or loss, and then the statement of financial position. And then you're told each column should have debit and credit column, which is duly balanced, which is duly what? Duly balanced. Sasa, in other terms, what you're required to do here is to prepare 8-column Excel worksheet, or basically to prepare 8-column a worksheet. That's why you can see we are required to have or our schedule, audit schedule should basically have 4 items: original trial balance adjustment, profit or loss, statement of financial position, and each of them should have 2 columns. So that will be a total. That will be a total of basically 8 what? 8 columns. 8 columns. So this is basically an audit schedule. An audit schedule which has got 8 columns. Yes, so basically here we will start with the details column. We will start with the details column, and then here we will have the original trial balance, because that's what you required here. Original trial balance without adjustments. We will have original trial balance. Original trial balance without adjustments. So basically, original trial balance without adjustment, remember we should have 2 columns, the debit and the credit column. The debit and the credit column. Then we will have the adjustment column, or the adjustment section. So the adjustment equally, here we have 2 columns, the debit and the credit. And then from there we have what? We have the statement of profit or loss. Statement of profit or loss. Statement of profit or loss. Statement of profit or what? Or basically loss. Equally, here we have 2 columns. The debit and the credit. And finally, we have the statement of financial position. Statement of financial position, like that. Now the statement of financial position equally, here we have how many columns? We have equally 2 columns, like that. Yes, in total, these are basically how many columns? In total, these are 8 columns. These are 8 what? Columns. Maybe I can split this. Yes, so the other thing maybe I also need to indicate up here is that our figures will be 1,000 of shillings. All the figures here will be 1,000 of shillings. Like that. All the figures here will be in 1,000 of what? In shillings, in 1,000 of shillings. Yes, so basically the first thing we need to do is to prepare the original trial balance. So we prepare the original trial balance using these balances which were extracted after balancing the ledger accounts. So like the first part is basically these are free marks. Because you just need to prepare a trial balance using these balances, you just need to know these items in the trial balance, will they be recorded on the debit or the credit column? Sasa? So therefore the first The original trial balance is quite simple, quite simple. I need to push this. Yes. Let me reduce this font size slightly, maybe to 11 like that. Okay, so now what we need to do is we prepare trial balance using what? Using these balances. Now what we just need to recall is this acronym here, the acronym of DIRA. Basically, I've said DIRA, D stands for drawings, because this is a company. In a company, you may not have drawings, but E stands for expenses and F stands for asset. Now, all these items in the trial balance, they will appear here. They will appear in the debit column of the original trial balance. But the other items, liabilities, equity, which comprises of share capital and reserves, and the revenue, which are also known as incomes, those ones will appear on the credit side of what? Of the trial balance. So having known that, we just need to transfer these particular values. We need to transfer these particular values in the trial balance. So capital basically is a component of equity. That one will go to the credit side of the trial balance. This one will go to the credit side of the trial balance. Let me do away with these particular decimal places. Yes, I do away with those decimal places. Okay, yes, I want to do away with those decimal places. Yes, so basically we have capital, which will go to the credit side of the trial balance. So then we have the other item, which is basically revenue. Any item of revenue go to the credit side of the trial balance. Then from there we have trade payables. Trade payables is a liability. It go to the credit side of the trial balance. Then we have a return outwards. A return outwards, remember, this one should be deducted from what? Do we deduct this from the sales? Do we deduct this from the sales? Do we deduct this from the purchases? Who can tell us? The return outwards. This one should be deducted from what? Return outwards. A return outwards. A return outwards should be deducted from what? Should be deducted from purchases. That's basically what you need to remember. And remember, whatever you are doing here require a lot of your knowledge on financial accounting, not even financial reporting, not even financial, whatever you did in advanced financial reporting, what you did in financial accounting. In financial what? In financial accounting. Sasa? Yes. Basically, this one is deducted from purchases, and we know purchases in the trial balance is debited. So take into account this should reduce, this one should reduce purchases. This one should be what? This one should be credited, because purchases should be on the debit side and return outwards should be credited, should be recorded on the direct opposite side of the purchases. So expected credit loss, I've said this is equivalent to the provision or the allowance for doubtful debt at the start. Any provision, any allowance in the trial balance as a credit balance. As a credit what? Balance. Discount allowed is basically an expense. This one will go to the debit side of the trial balance. Discount received is an income. Go to the credit side of the trial balance. Go to the credit side of the trial balance. The purchases is an expense. Essentially, that's what we know. It go to the debit side of the trial balance. Return inwards. This one should be deducted from the sales. And because sales is on the credit side, and this reduces the sales, this one should be debited. This one should be debited, return inwards. Distribution cost is an expense. It will go to the debit side of the trial balance. to the debit side of the trial balance. Drawings, remember D for drawings, this one should go to the debit side. To the debit side. Then rent, rates and insurance is an expense. Go to the debit side. Then heating and lighting, go to the debit side. Postage is still an expense, go to the debit side. Advertising is an expense, go to the debit side. I think no problem with this. So then salaries and wages, still an expense, go to the debit side. Credit loss. Credit loss, I've said that this is another name for bad debt written off. Bad debt written off, what is this? This one we know is an expense. Is that the position? Bad debt written off, is that an expense? Yes, that one would be an expense. Being an expense, basically, this one go to the debit side of the trial balance. We have cash in hand, which is basically a current asset or an asset, go to the debit side. We have cash at bank, still a current asset. We have inventory at the start, is an asset, go to the debit side. We have receivables, is an asset, go to the debit side. We have property, plant and property, equipment, and furniture is an asset, go to the debit side. And then we have accumulated depreciation. This accumulated depreciation, because it reduces the cost of the asset, that one go to the credit side of the trial balance, because essentially this is like a provision. And then depreciation expense for the current year, this one is an expense. Being an expense, it go to the debit side of the trial balance. So essentially, we have been able to extract, we have been able to prepare the original trial balance. The original what? A trial balance. And basically this original trial balance which you have prepared here, we are told should duly balance. Balancing means that whatever you have on the debit side, and basically whatever you have on the credit side, that one should be the same. That one should be the same. So basically what I want us to do, I want us to get those totals. I want us to get the totals here. We get the totals here. Just a minute. Yes, so let's get these totals. We see whether our original trial balance will balance. We get those totals. We do the auto sum. That one should automatically balance. Let's see. Yes, you can see this one is automatically balancing. Is automatically what? Balancing. Automatically balancing there. So because this is a trial balance. So we know that once you have extracted, you have prepared the trial balance, then the trial balance should do what? The trial balance should balance. Should balance. The total on the debit side should be the same with the total on the credit what? Should be the same with the total on the credit side. Sasa? Yes. So that basically what is required in part A. We have prepared the original trial balance. We have prepared the original trial balance. Then what we need to do basically is we move and we make the adjustment. Are we together up to that point before we move to make the adjustments? Are we together up to that point? Are we together up to that point? So that is all about preparation of the trial balance. Preparation of the trial balance. Preparation of the trial balance. This is something you did in financial accounting. That is something you did in financial what? In financial accounting. In financial accounting. Okay, so having that then, what do we need to do? We need to proceed and basically make the adjustment. So adjustment basically means that we need to make adjustment to some of the items in the original trial balance. We need to make adjustment to some of the items in the original trial balance. And I think in our case, we are given those particular adjustments to be made. We are given the adjustments to be made. So what we will do down here we come and we say that we want to make some adjustment. After preparing the original trial balance, we want now to make what? Adjustment. We want to make some adjustments here. We can bold that one. Yes. So now, what are we told here? We are told as you begin your audit process, you discover the following adjustment that should be made to finalize the financial statement as you carry out the audit. So we have the first item here, and that is the closing inventory. Closing what? Closing inventory. Closing inventory. So the closing inventory is basically an amount of 875. Let me ask here. So this closing inventory, should it be adjusted to any of the item appearing here? Do we adjust the closing inventory to any of the item appearing here? No. Closing inventory should not be adjusted to any of the item appearing here. If you can be able to recall, if, for example, you're preparing financial statement, you're given closing inventory, that closing inventory is not similar to depreciation, is not equivalent to accrued incomes and expenses. So this one is not adjusted to any of the item in the original what? Trial balance. So what you do, you have to take this particular trial balance, not the trial balance rather the closing inventory. This one we are going to take it to the statement of profit or loss and also the statement of financial what? Position. So what I'll do, I'll explain where to record that within the statement of profit or loss and the statement of financial position when preparing that. Maybe what we can do, let's mark this one in red, because this one we've got the statement of profit or loss. Then from here we have prepaid insurance. Prepaid insurance basically is insurance expense which was paid during the current year, but basically it's related to the following financial year. Now this prepaid insurance should be deducted from the insurance expenses which were paid during the current year. You can see we have insurance expenses which were paid. These include an amount which was prepaid. So what we need to do is to less that particular amount here. As we less that particular amount here. How do we less that amount here? Remember, we can't come back to this original trial balance and we start making adjustments here. So to less a figure from this, because you can see this appearing on the debit column, this is the debit column. To less a figure, we credit. To less a figure which is appearing on the debit column, we do what? We credit. So here in the adjustment section, remember this is the adjustment section. This is the adjustment section. So we will go to where we have insurance, which is this one. And on the credit side here, we are going to record that prepayment. By crediting it is basically to deduct. We are deducting that from the amount there, from that amount which are given there. That is the expenses which were paid. How much is that? Is this a figure of what? Of 560. And maybe I can do away with this particular decimals. Yes, so basically I've said I'll do what? I'll basically credit that. To credit, we are lessing this from that figure. We are lessing that. And then when making any adjustment within the trial balance, you must ensure you complete the double entry. You must ensure you're completing the double entry. We have credited this account, the rent, rates, and insurance. We have credited that account, and then we are going to debit the account called the prepaid insurance. We are going to debit this account called the prepaid what? Insurance. We debit that account. Why are we debiting this? Is because a prepaid insurance is a current asset, and therefore this one will still go to the balance sheet, to the statement of financial position, because it's a current what? Is a current asset. Is a current what? Asset. You can see how we have made that adjustment. We have debited the prepaid insurance account. We have credited the insurance account. So we have completed the double entry. So we do the same for the other item here. So we copy this. We have it here. So we have heating and lighting, which are accrued. These are expenses not yet paid. Now, the expenses not yet paid, number one, we know these are current liability. So these accounts should be credited in the adjustment section here. We should credit this because it's a liability. We credit. Number two, this one we should also add it to the heating and lighting expenses paid. You see, out of these particular expenses, there are some expenses which were not yet paid. So we need to add those expenses which were accrued. How do we add an amount to this? We need to debit this account. So to Takuja, we record that amount here in the adjustment section in the debit column. How much is that? The amount is 680. So, and I hope you can see when making these particular adjustments, in the adjustment section, we have to complete the double entry. We debit one account, we credit the other account. So that by the end of the day, this particular adjustment section will do what? We'll have to balance. We'll have to balance. So we are done with that. So then from there, we have the other item, which is basically prepaid rates. Prepaid rates. Prepaid rates. Prepaid rates, one, these are current assets. So we debit the account. And then where are the rates included? The rates are still included here, where still we had a prepaid insurance. Is that the position? Yes. So I think this account now will be credited with this. And then to this, we have to add another amount. We add it there still. We add this amount here. So you can see this value is arrived at by adding two values. The prepaid insurance and also the prepaid what? The prepaid rates. Sasa? Yes. So then next we move to the other item here. We are told expected or we are told earlier expected credit losses is estimated as what? As 1865,000. So here we have what? We have expected credit losses. So basically I say that when we talk about the expected credit losses, this is basically equivalent to what is known as the allowance or the provision for doubtful debts at the end of the year. Sasa, yes, money which is set aside to cater for the losses which will be incurred in the future once the customers decline to pay the year debts. Now, the first thing maybe we need to counter check is whether we have any allowance for doubtful debts here. Do we have any allowance for doubtful debts? Yes, we have this one. We have this one. And I hope you can be able to recall how we were accounting for the provision or the allowance for doubtful debt. We were comparing the provision for doubtful debt at the start and also at the end, basically to determine whether we have an increase or a decrease. An increase in allowance for doubtful debt is an expense, but a decrease is what? Is an income. A decrease is what? Is an income. So therefore, what we need to do basically is we compare those two values. The allowance for doubtful debts at the start, this one, and then the allowance for doubtful or the expected credit losses at the end of the year, this one. This one. What do we have? I think in our case, we have an increase. An increase from 1256,000 to 1865. So how much is the increase? That's basically what we are going to account for, the increase. The increase. Okay, the increase. The increase, this one will be equal to this minus what we have here. So the increase is 609. The increase is what? 609. Now this increase in expected credit losses, this increase in expected credit losses is what we are going to account for during the current year. And basically we are saying being an increase is what? Is an expense. So being an expense, this account automatically will be credited. We are going to credit this account, not credit, rather debit. All expenses are supposed to be debited. We debit this because it's a is an expense account. And number two, this expected credit loss at the start, we need to increase it with that amount. So to increase this, because it has a credit balance, we still credit that. We're going to credit this account with the increase. With the increase. The increase is this one. And therefore, you can see still we have completed the double entry by crediting this account and then debiting the account which is called what? The expected credit losses. Expected credit what? Losses. Simply because it's an expense. This is an expense. Yes. And I think we are basically done with this particular area adjustment. Though we also told that there were some omissions or basically some errors which were made. These are omissions or errors which were made. The omissions or errors which were made. So I think for these particular omissions or errors, we need to know how we're going to rectify them, how we're going to correct them. So we are told an invoice for goods sold was not posted. So this is an invoice for goods which were sold, which was not posted. So basically, what we know is that whenever the company sells goods on credit, the company has to send an invoice to who? To the customer. So this invoice, we are told, was omitted, was not posted. So if it was not posted, we then need to know which two items are we going to adjust. Which two items appearing in the original trial balance are we going to do what? Are we going to adjust? So this will be adjusted in which and which figure? This omitted invoice. This one will be adjusted in which two items? Who can tell us? Once you have omitted an invoice, which two items should you adjust? Which two items should you adjust? As if that is one item. Which two items should be adjusted here? Yes, the revenue and inventory. Okay. Once you make the sales, which two items should be adjusted here? Which two items should be adjusted here? Payables, hapana. Inventory, hapana. You make sales. What should be the double entry? Remember, I've said that this whatever you're doing here require a lot of knowledge on double entry. In fact, that is what here you must be in a position to know double entry. Naona watu wakubuki double entry. I can see that double entry is a problem. I can see that double entry is a problem. Here you are saying revenue and purchases. Hapana. Once you make sales, so once you make sales, you debit receivables, you credit revenue or sales account. That is the double entry. Once you make sales on credit, debit receivables, credit revenue or credit what? Credit sales. Sasa? Yes. So that basically the item. So, and remember this the were omitted, or these are basically omissions or basically errors which were made. So how do we correct this? Who can tell us now? To correct this, we will basically have the corrections here. We will not go back, we will not touch our original trial balance. And basically I'm saying number one, we need to increase this. It's not a must now because these are not here, are not any adjustments. We will not include their details here. So we will make the adjustment directly here without letting will be our solution. And we are going to start with part A. Part A of the question, what are we required to do here? We're required to prepare the forecasted statement of profit or loss. So basically, what you're told, there is some information which you're given here that Delaware Limited would like to evaluate its performance for the next 5 years. So basically, we are going to prepare this projected statement of profit or loss for the next 5 years from 2023, and basically that is the next 5 years from 2023. So we will start with the year 2023 here, 2024, and basically we're going to have up to which year? I think that one should be up to 2028. That's the position. Yes, because we have 1, 2, 3, 4, 5. Yes, it should be up to 2027. 5 years. 5 years. That's basically what we have. Now, how do we prepare this forecasted statement of profit or loss? So basically, to prepare the forecasted statement of profit or loss, we need first of all to compute the sales of the company. We will then proceed with less the production costs. We get basically what we get the gross profit, and then we less the other expenses. The other expenses or the other costs which are not necessarily production cost. Now, for us to be able to do that, we need to have all these variables, because you can see we are only given the variables for the first year. So we need to compute the variables, those variables for the next 5 years. So let's me copy this and have that on the other side here. I'll copy of those variables, and equally I'll copy for the first year here. That is the variables which are given for 2023. Yes. And then what we are given here is the growth rate. And basically, we're told that the following details relate to the main product lotus and the estimated changes in price and cost per annum. So whatever you're given here, these are the changes per annum. These are the growth rate per annum. So what we need to do basically, we need to compute the values for the next 4 years here. So the growth rate for these for the annual demand, this one we are told will be 10%. So this in 2024, the average annual demand in 2024, this one will be equal to 110% of this one. In other terms, this one will be equal to 1.1, which is the same with 110% times what? Times this. That's how. So we do the same for this other item here. That is the selling price per unit. This one will grow with 5%. So this one will be equal to 105% of the selling price of 2023. So this one is basically the same with what? Is the same with 1.05. 1.0 what? 1.05. 1.0 what? 1.05. So basically, let's do that. We take 1.05 times this one. Then direct material, this one will increase with what? 10%. So therefore, this one will be 1.1 times this value here. And remember what we are doing here, we are basically developing a formula. So this formula which we will develop here, we are going to apply that for the next 3 years. That's yes. Then the direct material here, this one will also grow with 10%. So basically, instead of doing that manually, we can be able to apply the formula we have up here. This formula will apply for direct labor because it will also grow with 5%, and also the variable production of items. That's yes. So this is 110% of this. Is 110% of this. That's yes. What about this one? This one will grow with 5%. So this one will be equal to 1.05 times this one. Yes. And basically, this administration of it, also this one will grow with 5%. I can also apply that formula down here for this other item. That one is 105% of this. So this one will grow with 10%. So this one will be equal to 1.1 times what I have here. I enter. And finally, this one will grow with 5%. So this one will be equal to 1.05 times what I have here. I enter. That's yes. So then what I'll do, this particular formula which I've developed for 2024, it will basically apply for the next 3 years. I'll just apply that formula there, and I'll be able to have the values for the next 3 years like that. Sasa, yes. So basically, we say that you can be able to confirm, for example, how we are computing each of the values here. So maybe what I need to do, let me do away with this decimal. I think we have decimals. Do we work with the decimals? Yes, let's work with our figures to 2 decimal places here. To 2 decimal places, 2 decimal places like that. 2 decimal places like that. Let me expand these columns here. Yes. So basically we said here, you can be able to confirm how all these values have been computed. For example, if you want to know how this figure has been computed, you just highlight that cell and then you come up here. So our formula is not appearing up there. Why is the formula not appearing? Our formula, remember our formula should appear up somewhere up here. I don't know why our formula is not appearing there. Okay. But the formula basically should appear up here. I don't know why it is not appearing. Yes, but basically our formula should appear up there. Yes. So, but basically if you check here, for example, this one is like 110% of this. 110% of that. I don't know why our formula is not appearing up there. Let me first of all close this and then I reopen afresh. I close this and then I reopen. Yes, I think now we should be able to have our formulas up here. So we said if, for example, yes, our formula is now appearing up there. If you want to know how any of the figure here has been computed, you just highlight that cell and you'll be able to see the formula up there. For example, this value here, you can see it's 110% of that, which is basically very much correct. So therefore, basically all these particular variables here, or we have been able to come up with these particular variables using the figures for the base period 2023 and the growth rate. Now, having these 10, what do we need to do? We need to compute the profit or loss. How do we compute this profit or loss? We can come up with a formula here. To compute the profit or basically loss, we first of all compute the sales. We first of all compute the sales of the company, then we minus the cost of production. The cost of production. So this is basically the production cost. This is the production cost. The production cost. We will get the gross profit, and then from there we move, and basically we less the other expenses. The other expenses, these are the non-production costs. The non-production costs which are incurred by what? By the company, or basically the other costs which are incurred by this company, which are not necessarily production what? Production cost. Production what? Costs. Sasa? Yes. So that's basically how we compute the profit or loss. So therefore, what we need to do first of all is we compute the sales. How do we compute the sales? This one is computed by taking the quantity produced and sold times the selling price per unit. The selling price per what? Per unit. So that's basically how we are going to compute this. So for 2023, I will take this one, the annual demand. Annual demand, remember the number of units to be produced and sold. This one, I'll multiply that with the selling price per unit. The selling price per unit is this one, like that. Then I'll basically do the same here, just like what you have done up here. I will basically develop the formulas for computing these variables for the year 2023, and then I'll apply that formula for the next 4 years. So that will make our work very easy here. So to these sales, we need to proceed and we less. We need to proceed and we less the production cost. The production cost. The production cost. Now, this production cost will comprise of what? This one will comprise of direct material cost, direct labor cost, variable production of heights, and then the fixed production of heights. These are production costs. But if you check on administration, these are not production costs. The variable selling and the distribution are not production costs, and the fixed selling and distribution still not production what? Cost. Let me first of all, I list this particular production cost, but I need to do some editing as far as this is concerned. This one should not be per unit. Direct labor will not be per unit. Will not be per unit. The variable production of heights will not be per unit. Yes, so that basically what we need to have there. So I will start by computing direct material cost. Direct material cost, this one is equal to direct material cost per unit, this one, times the unit produced and sold. And I hope you can be able to record, we said at a CVP, we assume the units produced are RR, the units produced are equal to the units sold. We don't have closing stock here. So I will multiply that with the unit produced, this one. For the labor cost, I will do the same. Labor cost per unit, this one, times the number of units produced and sold, 50,000. Then variable production of heights, I will take the variable production cost per unit, this one, times the number of units produced and sold, this one. Then for fixed production of heights, this one does not depend with the number of units produced. This one, we take that amount there. Yes. Sasa, yes. So then from there, what we need to do is basically we get the gross profit. We will get the gross profit. The gross profit. How do we get the gross profit? The gross profit will be equal to the sales, this one, minus the production cost, minus this, minus this, minus this one, minus this one. So the sales minus the production cost. We get what? We get the gross profit there. So once we get that gross profit, we need to proceed and we less the other costs of this company. We need to less the other cost, and basically I've said that these other costs are the non-production costs. Other costs. Other what? Other costs. So the other costs, basically, these are the other costs of this company, which are not necessarily a production cost. So I think I will pick these three costs here. I copy them. I bring them down here. Yes, I will start with administration of height. And administration of height, I say that this one take into account, we are given a figure. This is a fixed cost. This one will not have to be based on the number of units produced and sold. Variable, selling and distribution, this one will not be per unit, but basically this one has to be computed. This one will be equal to the variable selling and distribution cost per unit, this one, times the number of units produced and sold, these ones, 50. Then the fixed selling and distribution is what we have here. That one is equally not per unit. Yes. So I think having that now, we can basically proceed and we compute what? We compute the profit, the profit for the year. The profit for the year. The profit for the year, of which now the profit for the year, this one will be the gross profit minus the gross profit minus the other costs. Minus the other what? Minus the other costs. So this one will be equal to, the gross profit, this one, minus these three costs, minus this, minus this, minus that one. We get what? We get the gross what? We get the gross profit. And I think having this now, we are done. We are done because we have developed a formula here. So what we just need to do is we apply that formula for the next word 4 years here. We just apply that formula for the next word 4 years like that. Just like that. Yes. So maybe just need to expand our columns here. Yes, so basically that's what you have, and maybe you can underline what need to be underlined here. We can underline this. We can equally underline those two values here, like that. Yes, so basically in our case, we have the profit for what? The profit for the year there. And basically this is it, that what is required as far as part A of that particular question is what is concerned. That is what was required there. You can see that one is quite simple. Quite simple. Quite what? Simple. Variable setting and distribution. Variable setting and distribution. Variable setting and distribution. Variable setting and distribution. This one rules. We have said this one has to be. I hope you can see up here. This one is per unit. So that's why we have taken this particular amount. I hope you can see how we have computed that. We have taken this times the number of units produced and sold, times the number of units produced and sold, this one. That's why we got, I think, a figure of 1.5. This times that. That the variable setting a distribution cost per unit times the number of units produced and sold. Yes. So in our case, basically we are done with that. And we said the advantage with Excel is to make our work easier. You can see we just need to come up with a formula for computing those figures for the first year. Once we are done with that, we just need to apply that formula for the next 4 years. So which basically becomes quite what? Simple. So let's move to the other part of the question. We copy this. We copy this, and basically we have it down here. Yes, so what you're required to do here is we compute the break-even levels in units, the break-even in revenue for each of the next 5 years. In other terms, what you're required to compute here are two things: the break-even point in units, the break-even point in what? In shillings. I hope you can be able to recall what we said yesterday, how we compute the two. How do we compute the break-even point in units? This is basically how we compute the same. We take the fixed cost divided that with the contribution margin. Yes. For the break-even point in revenue, or basically in shillings, we compute that by taking the fixed cost divided that with something called, okay, yes, there we just use the same formula up here, but whatever we get, we can multiply that with the selling price per unit. Yes. So we need to have some items here. Number one, we need to have the fixed cost of this company. We need to have the fixed cost. The fixed what? The fixed cost of this company. Now, the fixed cost, basically this comprises of the fixed production cost and the other fixed cost, or the total cost. We don't, here we consider all the fixed costs, not necessarily the production fixed cost, but all the fixed costs, all the fixed what? Cost. Now, this company has got a number of fixed costs from what we have up here. So number one, we have this fixed production of height. That is basically the fixed cost. And then do we have any other fixed cost? Yes. We also have this, the fixed administration of height. And then we also have this fixed selling and distribution, this one. Yes, we consider all the fixed costs, all the fixed what? Cost. That will basically give us 240,000. Then, having said, we also need to proceed and we compute something called the contribution margin. The contribution margin. The contribution margin per unit. The contribution margin per unit. How do we compute the contribution margin per unit? The contribution margin per unit, this one is equal to selling price per unit, represented by small p, minus the variable cost per unit. The variable cost per unit. And equally here, when considering the variable cost, we consider all the variable cost of the company. We consider all the variable cost of what? or the variable cost of the company, or the variable cost of the company, or the variable cost of the company, or the variable cost of the company. As this is asking about administration of it. Yes, basically I've said, if you check on the data which you have here, you can be able to tell which costs are fixed. Any cost which is not given per unit is fixed. This one is fixed because you can see it's not per unit. This one is also fixed, it's not given per unit. This one is also fixed. That's why I've said we have 3 fixed costs. This one, this one, and this one. These are fixed costs. The 3 are fixed costs. They are fixed costs because they are not given per unit. If they are per unit, then they should be variable. Now, let's move and we compute the contribution margin. And basically, contribution margin, I've said we take the selling price per unit. So the selling price per unit, we have it here, this one, 500 minus all the variable cost. The variable cost, we have direct material. I'll take 500 minus direct material, which is a variable cost, minus direct labor, minus variable production of it, minus the variable selling and distribution, that one. So I've taken the selling price per unit minus 4 variable cost per unit there. I'll get what? I'll get the contribution margin per unit. This contribution margin per unit, how is that computed? I hope you can see the computation of that. This one minus the 4 what? Variable costs. Yes. So basically having that then, I can proceed and I compute now the break-even point in units. Break-even point in units. So how do I compute the break-even point in units? I'll basically apply this formula. I'll take the fixed cost, divided that with the contribution margin per unit. The contribution margin per unit. And basically that is what we have up there. So I'll take the fixed cost, this one, divided by this one there. That will give us the number of units to be produced and sold for the company to break even. And I think we can also have a value there, 2 decimal places like that. The next, I also need to compute the break-even point in shillings. The break-even point in shillings. The break-even point in what? In shillings. So to determine the break-even point in shillings, we just take whatever you have up here. That is the break-even point in units. Break-even point in units. I multiply that with the selling price per unit. The selling price per what? Per unit. So I'll take whatever I have here times the selling price per unit. The selling price per unit, I have it up here, this one. So that will basically give us the break-even point in what? The break-even point in what? In revenue, or basically in shillings. So having that now, for the first year, 2023, I just need to apply that formula for the next 4 years. For the next 4 years like that. Yes. So basically that is the break-even point in units, the break-even point in what? In shillings. In what? In shillings. We are done with that. So we move to the last part here. We move to the last part. Let's copy this. In case of any question, please type it in the chat box. I'll be able to see it. So here we are told using suitable graphs. Using suitable graphs, summarize, that is suitable graphs. Summarize the revenues, the profit, the break-even revenue for each of the next 5 years. So I think in this case, what you're required to do here is to come up with a dashboard. A dashboard is basically a summary of the key financial metrics and also accompanied with data visualization tools. Yes, so basically I think what we need to do here, let's have our years 2023, 2024 all the way to 2027. Yes, so I think maybe first of all, you can have a summary of the revenue. I think we can present this, all the values separately. So the revenue will start with the revenue for 2023, which is this one. I'll basically enter and then basically apply that. All the values we have up here, all these revenues are the figures which we have down here. Yes. And I think in that case, we can first of all present this, the revenue separately in a graph. We said once you have that, we just need to highlight the entire data there like that. And then we come up here, we say insert. We come to the recommended charts here. You'll be given some recommendations here. Some recommendations like that. Maybe you can pick any of these. For example, you can pick that, but you can see there is some space which is left here. That space is because of whatever you have here. Whatever you have, this particular empty what? These empty columns here. That's why we have some space. Though no problem with that. Let me see here. So we insert. Yes, you can see that space is disappearing. You can see that space is disappearing. Yes. So basically, this is a graph which shows the projected revenue of this company for the next what? For the next 5 years. For the next what? 5 years. For the next what? 5 years. So I think we are done. See, you'll be able to do that for the other two variables, because you just need to do the same for profits. For profits, so you'll have the profit for the 5 years and also the break-even point in revenue. So you'll be in a position to do that. Mary, Sharon. Yes. Let me give that as an assignment. Let me give that as an assignment. Sasa? Yes. So you finish on that, and then so that we move now to the other question. So you can see this question was a simple one, a simple one, because that is a question which you could have done within very few minutes. You're done and you get all the marks. Sasa? Yes, it was a simple question. So that is basically what was required there. There is now this other question, which was the last sitting. Last sitting. Yes, we have it here. I hope you can see this question here. The question I'm presenting, this one is for August of 2025. If you can see the question for August 2025, please confirm. Please confirm. Can you see this question for August 2025? Or you can only see the other question which we... Okay, sawa. Can we take a short break before we come back and look on this? We take a short break of just like 5 minutes. I want us to finish on time today. I release you a little bit earlier. We take a short break, small breather of small breather. Or we just continue? Okay, so we take a small breather of 5 minutes. Then we come back, we look on this. So a small break, we come back. Yes, are you back? Can we continue? Can we proceed? Yes. So let's continue so that we finish on this question. So we are told you are the management accountant of Maras Tech Limited, a company that produces two types of product, alpha and beta. Alpha and beta. So we are told the company want to understand the cost structure, the profitability for both a product as well as the break-even point based on the following data for the month of July 2025. So we are given data about the two companies, about two products, not companies, about two products. Basically, we have two products, alpha and beta. So what we have is the selling price per unit, the variable cost per unit, the fixed costs, and the unit sold. So what are we required to do? Part A, I think we got straight to part A of our question here. Part A, basically we are required to do what? We are required to prepare the contribution margin statement and the profit, net profit for each of what? For each of the products. So we basically copy that. We paste it here on the other side. Yes, so we are required to prepare the contribution. So this is basically the contribution. This is the contribution margin statement and the profit what? And the profit statement. So remember here we have two products, unlike the other question which we had, which were preparing the profit statement basically for a number of years. So here we are preparing the profit statement for 1 year, but basically for two products. So we need to copy this, our two products, and basically we have that here, the two products, product alpha, and basically product what? Beta. Now what we are required to do here is we prepare a contribution, a contribution margin statement and the net profit statement. So basically what that means, we need to show the contribution for each of the product, and that is the total contribution and the profit. So how do we compute the contribution? Contribution is equal to the sales minus the variable costs. And then the net profit is equal to the contribution minus the fixed cost. Because I hope you can see in this question, we just have two costs. We just have two costs, the variable cost and the fixed cost. So to get the contribution for each of the product, we will take the sales minus the variable costs. And then to get the net profit, we take the contribution minus the fixed cost. So what do we start with here? We start by computing the sales. We start by computing the sales. Yes, let's have all these variables here first of all, before we proceed to do that. Maybe we need to use some of those variables down. Maybe in answering the other part of the question, we need to have these variables here. These variables here. Yes, and basically we have the other variables for the other product. Yes, so we don't have to copy for the other product. By default, Excel will be able to pick for us those values. So we need to start by computing the sales. So this paper for last sitting is basically, it was a very simple paper. It was a very good paper. You can see the kind of questions. I think we have done a number of questions, but it was a very good paper. It was a very good paper. Let's hope the paper for this time will also be as simple as this paper for last sitting. So to compute the sales, basically for each product, I will take the selling price per unit times the number of units produced and sold, these ones. As simple as that. Then I basically need to less the variable cost so that I get the contribution. I need to less the variable cost, the variable cost. So the variable cost, this one will also be straightforward. We will take the variable cost per unit, this one, times the number of units produced and sold, this one. And then I'll get what? I'll get the contribution. I'll get the contribution. The contribution. So the contribution here, this one will be equal to the sales minus the variable cost. Sales minus the variable cost, that one. And then I need to proceed and I get the net profit. To get the net profit, I'll take that contribution, I less the fixed cost. I less the fixed cost. I less the fixed what? The fixed cost. So the fixed cost is basically what we have here. So meaning that the net profit, this one will be equal to what? This one will be equal to the contribution minus the fixed costs, like that. Like that. Yes. So basically, I think I can bold this one before I apply that formula for the other product. Let me bold that one. I can also shade it. Yes. So basically, what I need to do, I apply this formula for the other product like that. For the other product like that. I think I can introduce a comma here. Okay, so I think that is it. Okay, I don't know what is happening. This value for 200. Okay, let me do away this particular comma here. Same case there. Okay, so let's retype these figures manually. I don't know what is the problem with those figures. 200,000. And these other ones should be 200,000, 300,000. Yes, I think now they should be okay. Yes, so that should be okay now. That should be okay. Yes, alternatively, we can use that. Formula as is. We compute the contribution margin per unit times. Yes, but I think either of the approach should give us the correct answer. Either of the approach should give us the correct answer there. Yes, so I think basically that's what we have. Yes, so what you have computed is the contribution. You have also computed what? The net profit. So basically it was simple as that. So we move to part B. So in part B, basically what are we required to do? We are required to calculate the break-even point in units and revenue for both product. For both what? For both product. Basically here, we are not required to compute the break-even point for the company, because if we are required to compute the contribution, if we are required to compute the break-even point for this company, we need now to introduce the aspect of the wing. So, but here we are required to compute the contribution, the break-even point for each product. For each what? A product. So which basically becomes quite simple here. So that will be part B of the question. So this is the break-even point. The break-even point in units and basically the break-even point in units and also in revenue. Yes, so how do we compute this? We just need to remember the formula. To compute the break-even point in units, we take the fixed cost divided by contribution margin. I think what is missing here is just the contribution margin. Let's just compute that one. Contribution margin per unit. Contribution margin per what? Per unit, which will be equal to the selling price per unit minus the variable cost. So for each product, so this one will be equal to the selling price, this one, minus the variable cost, this one, which is how much? Which basically will give us 400. Yes, which will give us 400 like that. And I hope these units are okay. So I think we have a problem with these particular values here. I think the person who was typing them introduced a comma. That's why you can see. They are not aligning on the left like the other values. Because they should be aligning on the left. Okay, so I think it's okay then. So then, okay, we have now the contribution margin. So having the contribution margin, we can proceed and we compute the break-even point in units. So the break-even point in units, we just need to apply our formula here, which will be equal to the fixed cost divided by contribution margin, and which should be per unit. So this one will be equal to the fixed cost, which we have up here, divided by the contribution margin, this one, and that will give us 500 units. Then we compute the break-even point in revenue, or basically the break-even point in shillings. And you have said that this one will be equal to the fixed cost, or in other terms, the break-even point in units, and then we multiply that with what? We multiply that with the selling price per unit. As simple as that. So therefore, this one will be equal to the break-even point in units, this one, times the selling price per unit, this one. Yes, so that basically give us the what? 350. Having that, then we need to apply that for the other product like that. So in that case, we have computed the break-even point in units and basically for revenue for both products, that is product alpha and the product what? Beta. Product beta. Quite simple. Quite simple. Yes. So we move to the other part here. That is basically part C of the question. Part C of the question. So what you're required to do here is to compute the margin of safety. So provided you remembered the formula here, this was a simple question here. Yes. So margin of safety in units and as a percentage. Now, how do we compute the margin of safety? Margin of safety basically is the difference between the current sales, what the company is producing and selling, and the break-even point. And the break-even what? Point. So therefore, to compute the margin of safety, we take the current sales, and actually we are taking the current sales in units because we are required to compute the margin of safety in units. The current sales in what? In units. In units minus the break-even point in units. The break-even point in what? In units. The break-even point in units. Then to compute the margin of safety, the margin of safety as a percentage, margin of safety as a percentage, we do the same basically. We will check the current sales. Maybe I can just use, let's have the opening bracket here. The current sales basically in units minus the break-even point also in units. We get the difference and then we divide that with the current sales equally in units, and then by the end of the day, we multiply that with 100. We multiply that with what? With 100. That will give us a margin of safety as a percentage. So let's start by computing the margin of safety in units. So this one will be equal to the current sales. How many units is the company currently selling? So the unit being currently sold 1,500 minus the break-even point in units. Break-even point in units is this. And what does this mean? This basically means that if the current sales, if the number of units being sold, currently sold by the company reduces with 1,000, the company will obviously start making losses. That's what we mean by that. So then the break-even, the margin of safety, that is, as a percentage, we will basically take this difference because this is now the difference between current sales and the break-even point in units. We divide that with the current sales, this one, which is 15, and then we multiply that with 100. We multiply that with 100. We multiply that with what? With 100. We have taken the difference between current sales in units and the break-even point, which is what we have here, and then divided that with the current sales in units, 1,500 times 100. So that will give us this one as what? As a percentage. Okay, so I think we can do this. Let's do this. Let's do away with this particular 100. And then whatever you get, we basically introduce what? Introduce a percentage here. Yes, and equally we can give our answer to the nearest whole number, like that. So then we basically apply that for the other products there. For the other product. So what you have computed here is the margin of safety in units and the margin of safety in what? As a percentage. As what? As a percentage. As a percentage. Yes. Quite simple. So let's move to part B. To part D. Part D, we are required to carry out sensitivity analysis. I hope you know what is sensitivity analysis. Sensitivity analysis basically we try to change our original variables and we see how that will impact on the profit, how will that maybe will impact on the break-even point of this product or maybe the profit of this company. What are we told in part D? We are told to perform sensitivity analysis by calculating how a 10% variable change in all inputs, in all product data, that is, in all product data, other than the fixed costs, for both products, affect the contribution and the break-even point. So in other terms, what we're required to do here is that we vary, we change all the inputs except the fixed costs. And in that case, we are assuming all the inputs are changing, or basically we assume a 10% variable change. Variable what? Change for all inputs except the fixed what? Cost. And we see how that will affect what? How that will affect the contribution margin and the break-even point. Yes. So let's copy this. We have it here. Yes, I think this was a very, very good question. A very, very good question here. Yes, so basically we need to have equally our products, our two products down here. Maybe we can just recopy them afresh. Yes, so we have our two products. So remember, we have now the inputs which you're using here. Basically, we have this input, 4 of them. We just copy all of them. So we need to have our inputs here. And basically, we are required to change all these inputs, except what? Except the fixed cost. And we assume that all the inputs are, or we have a 10% variable change. 10% variable change. I hope you know what is 10% variable change. In case of things like the selling price, things like the number of units to be sold, because these result to sales, these two variables we are going to assume they will increase with 10%. But for the costs, we assume or basically a 5% variable change for the cost they reduce. Sales, the selling price, units sold, a 10% variable change. Those two variables do what? Increases. Will do what? We increase. So therefore, the selling price here for these two products will increase with 10%. So the selling price, this one will increase with 10%. We take this one and basically we increase it with 10%. To increase that with 10%, we just need to multiply that with 1 times 1. So that will come to 770. For the other product, we just apply that formula. And that one will go to 990. That is 10% variable change. Now, for the variable cost, a 10% variable change, we assume that this one reduces by 10%. Reduces by 10 what? 10%. Reduces by 10%. Now, as this, check what we are told here. We are told to assume a 10% variable change. That I think that basically what we need to 10% variable change. 10% variable change means what to the selling price? %10 variable favorable change. The selling price will reduce. Understand. Favorable. Favorable means what? Favorable. Remember the other question which we did. There was adverse. So that's why I think we are reducing the selling price. Sasa is here a 10% favorable change means that if it is sales, the sales increases. So anything which is used in the computation of sales, we are going to increase it with 10%, including the selling price per unit, including the number of units to be sold. But now for the cost, a 10% variable favorable change for cost, we assume they will reduce. Do we agree on that? Do we agree on that? Yes. Selling price automatically here will increase. Selling price will increase. The other variable we are going to increase is the number of units to be produced and sold. But for the cost, a 10% variable favorable change is a decrease as far as the costs are concerned. That's yes. I think you have agreed on that. So therefore, the variable cost, this will reduce because the cost. So this one will reduce by 10%. It will be 0.9 times 0.9 times what we have here, this one. So that reduces to 270. And basically, we do the same for the other product, which is beta. It reduces from 500 to 450. Now, the fixed cost, we are told that this one we assume it will not change. The fixed cost remain the same. The fixed cost remain the same. Remain the same. So the unit sold, this one, because it is used in computing the sales, a 10% favorable change, we assume that this one will also increase with 10%. This will be 1.1 times the current units produced and sold, 1,500. So that will come to 1,650. And then for the other product, it will go to 1,320. So then after changing those variables now, we are required now to see how that will affect the contribution margin, and also how it will affect what? How it will affect the break-even point. So we need to compute what now here? What we need to compute is the contribution margin, and not per unit. That is the total contribution margin and the break-even point. So let's compute the contribution. I'm saying this is a question which was very, very simple. Very, very simple. These are questions which these were just like 23 marks. This was a very, very good question. Yes. Now, how do we compute this one? We will take the sales minus the variable cost. The sales minus the variable what? The variable cost. The variable cost. So the sales, I think we can compute this directly. So we will take this. I think we can have the opening bracket here. The sales times the selling price per unit. Not that is the selling price per unit times the number of units to be produced and sold. That will give us sales minus the variable cost. The variable cost will be equal to the variable cost per unit. Equally, I need to put that inside the bracket times the number of units to be produced and sold. This one. Yes, I've taken the sales minus the variable cost. And that basically will give us that. Then we do the same for the other product there. For the other product. So how what is happening to the contribution here? What is happening to our contribution? I hope you can see our contribution up here. So this one was 600 for 80, but you can see now the new contribution is basically increasing. So by assuming a 10% variable change in all inputs except the fixed cost, you can see now the contribution, the new contribution is basically doing what? We have an increased contribution. Then we also need to compute the break-even point. The break-even point, and I think we can compute this one, break-even point in units, break-even point in shillings. Yes. So we start by computing the break-even point in what? In units. We just need to apply this formula. The fixed cost remain the same. This one, 200, divided by contribution margin per unit. Contribution margin per unit, this one, I'll compute that as the fixed selling price per unit minus the variable cost per unit. This one, I must put it inside the bracket like that. Yes, so that will give us what? That will give us 400 units. What about the other one? It will be 556. And because maybe these are units, I can give this one to the nearest whole number simply because these are units. These are units. So you can see the break-even point. Initially here it was 400. Sorry, it was 500 and 750. But now the break-even point is what? Is reducing. So the company now need to produce lesser number of units to do what? To break even. Finally, we compute the break-even point in shillings, which is equal to the break-even point in units, this one, times the selling price per unit. The new selling price per unit is this one. And basically, we do the same for the other product there. For the other what? Product, which will be 308,000 and 550,000. So that one is still reducing. That one is still what? Reducing. Now, that is basically what was required here. And this was a very simple question, a very simple one in relation to the break-even point, computation of the break-even point, computation of the contribution, computation of what? The margin of safety. That was a nice one, a very simple question on what? On break-even point. Yes, I hope basically you have understood what you have done. Have you understood what you have done in relation to that question? Have you understood what you have done, sir? Understood what you have done, sir? Yes, yes. So this was a very good one, a very simple question on the break-even point. And I think basically that brings us now to the end of that area of break-even point. So it means that once now we meet in our next class, we will basically proceed and do something to do with the preparation of budget. So I think for the budget, we're going to look on how we prepare the cash budget. There was a very good question on cash budget, which was examined, I think class sitting but one, and equally how we prepare something to do with the flexible budget. The flexible what? Budget, the flexible budget. Yes. So I think basically for today we can stop at that point, because I think we are done with what we had we wanted to cover today. So let's basically stop at that point for now. We continue from there on Saturday as we move to something new. Sasa, yes. So have a good night. See you on Saturday. That is question number 3. 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 I hope you're there. I hope you're there. I hope you're there. August 2025. Question number 3. There is something we did in relation to that question because I think we have the aspect of deferred consideration. So there is small. There is something small we did in relation to that question. So let's go to that question because of time. Because of time. Are you there? Are you there? Are you there? Okay, sawa. So what are we told in relation to that particular question there? So the question is, on 1st of January 2024, a Pool Limited acquired 80% controlling interest in Shape Limited when the retained earnings of Shape Limited amounted to 3.2 million. The acquisition consideration consisted of an immediate cash payment of 12 million on 1st January 2024 and a further cash payment of 12.1 million deferred until 1st January 2026. I hope you can remember there is something we did in relation to that, of which we said, because that is a consideration to be paid in future, we said it has to be discounted to its present value using the parent company COC, the parent company cost of capital. So then you're told Pool Limited has a cost of capital of 10%. That one automatically is for discounting that deferred consideration. And then you're told no accounting entries have been made in respect of the deferred consideration. Then you're told Pool Limited also acquired 50% of the equity interest in 𝐎𝐍𝐿𝐶 Limited and obtained joint control over 𝐎𝐍𝐿𝐶 Limited on 1st of January 2024. The purchase consideration comprised of an immediate cash payment of shillings 10 million on 1st January 2024. The retained earnings of 𝐎𝐍𝐿𝐶 Limited stood at 2.5 million on 1st January 2024. So 𝐎𝐍𝐿𝐶 Limited therefore is a joint venture. Then you are given the financial statement of the 3 companies. We have the statement of financial position for Pool, Shape, and 𝐎𝐍𝐿𝐶. We are given additional information number 1 all the way to note number 4. What are we required to do? Part A, we are required to calculate the value of the goodwill arising on acquisition of Shape on 31st of December 2024. You can see the marks which are given here for computing the goodwill. But the reason why we have okay, Sawa. I'm told this one should be April. Sorry for that. This one I'm told, yes, I think we did in our previous class, we did the question for August. Sorry for that. This one should be from the paper for April. I think we did the question for August in our previous session. This one should be from the sitting of April. The sitting of April. Let's go to that question very fast. Sorry for that. Yes. So in this case, we are given some additional information there. What are we required to do as far as our question is concerned? Part A, we are required to compute the goodwill arising on acquisition of Shape Limited. Then Roman 2, we are required to compute the value of interest in 𝐎𝐍𝐿𝐶 Limited as at 31st of December 2024. And Part C, we are required to prepare the consolidated statement of a financial position of Pool Group. Now, remember what we said is that once you come across such a question for group account, the first thing you need to do always is to come up with a group structure. Then having group structure, you'll do what? We will then go through the additional information we see and there are things which are required. Then from there, we proceed and basically answer our question. So the first thing basically we need to do here is to come up with the group structure. The group structure. So when we have information about the group structure, this information we have it within paragraph 1. Let's go back to paragraph 1. I think paragraph 3 of our question. So in paragraph 1, we are told on 1st of January 2024, Pool Limited acquired 80% controlling interest in 𝐎𝐻𝐿. So we are told the company which is called Pool Limited basically acquired 80% controlling interest in the company which is called what? 𝐻𝐿 Limited. On which date? On 1st of January 2024. 1st of January 2024. So we will come back to that paragraph, specifically in computation of goodwill. Then in paragraph 3, we are told Pool Limited also acquired 50% of the equity interest in 𝐻𝐿 Limited and obtained joint control over 𝐻𝐿 Limited on 1st January 2024. So this company, that is Pool, acquired 50% shareholding or 50% equity interest over in a company which is called 𝐻𝐿 Limited. On which date? Still on 1st of January 2024. On 1st of January 2024. This, therefore, is our group structure. From this group structure, we can therefore conclude that Pool Limited, this will be the parent company. 𝐻𝐿 Limited will be the subsidiary, whereas 𝐻𝐿 Limited will be what? Will be the joint venture. Will be the joint what? Venture. It basically means that when preparing what we are required in part C, consolidated statement of financial position, what are we going to do? We are going to combine similar items. You're going to add similar items of assets and liabilities, those of the parent and those of the subsidiary, that is 𝐻𝐿. Are we going to include the assets and liabilities of 𝐻𝐿? No. In relation to this, we are going to compute something called investment in joint venture, and that is the only item we are going to recognize within the consolidated statement of financial position. In other terms, we don't consolidate a joint venture. We don't combine assets and liabilities of the parent and those of the joint venture. And also remember, we have said the same applies also to an associate. Now, I think we have that. Can we first of all go back to paragraph 1, because we have something to do with the deferred consideration. Deferred consideration, maybe you can just do some work in relation to that. Deferred consideration. And I hope you can remember was it in our lesson number 1? When we started on this topic, we were able to look on the various forms of purchase consideration. And actually we did something in relation to this question. We said that deferred consideration has to be discounted with present value. We did that, and also we amortize that. Yes. So basically, going back to that information which we have in paragraph 1, the second sentence we are told, the acquisition consideration consisted of an immediate cash payment of 12 million, and on 1st January 2024, and a further cash consideration of 12.1 deferred until 1st January 2024. Pool Limited COC, that is cost of capital, is 10%. So basically, that is a deferred consideration. What we say is that such consideration has to be discounted to its present value. We have to get the present value of that deferred consideration. You can see the date of acquisition is this one, 1st January 2024. That consideration has been deferred. It will be paid on 1st of January 2026. And actually, here we have 2 years, because we have 1st January 2025 and 1st January 2026. So that consideration will be paid after 2 years from the date of acquisition. So because that has to be on this date in the computation of goodwill, we say we have to discount it. We have to do what? To get the present value of that deferred consideration. The deferred consideration is basically 12.1 million. And if you check all our figures in the statement of financial position are in thousands of shillings. We have to be consistent. We are going to work with all our figures in thousands of shillings. In thousands of shillings means any figure we take from the additional information, we omit the last 3 zeros. How do we discount this to its present value? We say we take the deferred consideration, we multiply that with the present value interest factor at the rate of 10%, which is the parent company cost of capital, and for 2 years. For 2 years, we said in a fund, no one will give you those present value interest factor tables like in a firm. So you have to work with the formula here. Sasa, Yes. So the formula for getting this, we said is 1 plus R. 1 plus R, because this is not an annuity, we raise that to power negative n. That is the formula. So we multiply that with 1.1. So 1.01, we raise that to power negative 2. Power negative 2. And this one will give us what? This one will give us what? And I can remember we computed this 1.1 raised to power negative 2 times 12, 100. Yes, so this one will give us what? This one will give us 10,000. Exactly 10 what? 10,000. 10,000. 10 what? 10,000. 10 what? 10,000. So that is basically the deferred what? Consideration. Now, when computing the goodwill, are we going to use the amount of 12,100? No. We will work with this one. Then what we said essentially is that this consideration has to be amortized. And I hope you can remember the reason why we have to amortize this. Number one is for us to determine what will be the value of this deferred consideration at the start, because this is the value of deferred consideration here. So what will be the value for the deferred consideration at the end of the year? That is on 31st of December 2024, when preparing the group account. We need to amortize this. And actually, in our case, we're going to amortize that just for 1 year. To determine the value for the deferred consideration at the end of the year. And number two, we determine the interest. Because we said in the process of amortizing this, we have some what? We have some interest. I think we can just do this instead of preparing the amortization schedule. We just compute the interest. What will be the interest on deferred consideration? The interest on deferred consideration, we say, should be computed using this rate times the value of deferred consideration at the start. The value of the deferred consideration at the start is 10,000. And basically that will give us what? That will give us 1,000. So this 1,000, basically we said, if we are required to prepare the consolidated statement of profit or loss, and I think I explained this one should be accounted for as part of the finance cost. If we are preparing the consolidated statement of what? Profit or loss. Are we preparing that? No. So number two, that will be the interest. So because we are not preparing the consolidated statement of profit or loss, this one will be deducted from the retained earnings of the parent company. The parent company was supposed to account for this as an expense, but basically it was not accounted for. That's why in paragraph 2, we are told this deferred consideration had not been accounted for. So this one will be deducted from the retained earnings of the parent. Number two, we also need to determine what will be the value of the deferred consideration at the end of the year. The date we are preparing the consolidated statement of financial position. We said we take the deferred consideration at the start. To that, we add interest for that year minus the payment which was made. If you can be able to recall what we did, we did all these workings in the amortization schedule, but essentially this is how we compute the same. So meaning that the value for deferred consideration at the end of the year will be 11 billion. So this is now what we are going to recognize in our consolidated statement of financial position as an non-current liability. As a non-current what? Liability. Sasa, yes, as a non-current liability. So that basically what you're going to or basically that is what is important for you to know as far as that deferred consideration is concerned. We are done with that. Then we will automatically come back to that information in paragraph 1, specifically when answering Roman 1, that is in computation of goodwill. Then note number paragraph 2, paragraph 3, do we have any working? No. What I want us to do now is we go to the additional information. And actually in the additional information, you will be able to see, we will come across the consolidation adjustment which we discussed in our previous in our previous sessions, and also the consolidation adjustment we came across in the question which we did. In the notes, you'll be able to see, you'll be told that this company on the date of acquisition, it revalued the assets. There was a fair value adjustment, but never accounted for that. You have to record what we do. Number two, you may see that we are told that this company, or there was an amount of intercompany debt, there was maybe something like unrealized profit. Those are the items you should expect in the additional information. That's why we say from the question we did in our previous class, it is important for you to know how to deal with those consolidation adjustment. Let's go to the notes now. Additional information number 1. what are we told? We are told that the date of acquisition, and this is something you'll come across in all questions for group account, and it's not one. Why you'll be told this company valued the asset. Like, let's see what we are told there. We are told at the date of acquisition, the fair value of Shape Limited net asset approximated their carrying amount with an exception of some plant whose fair value was shillings 1 million above its carrying amount. At this date, the plant had a remaining useful life of 5 years. No fair value adjustment is necessary in respect of 𝐎𝐍𝐿𝐻. 𝐎𝐍𝐿𝐻 is the joint venture. So what are we told? We are told this company revalued the asset. And this is the same thing we came across in the other question which we did, and it was still not number one. Sasa, yes. So in a question for group account you'll come across, usually note number one, you'll be told this company revalued the asset. And we say you make two adjustments. Adjustment for revaluation gain and depreciation other charge. So we are going to do the same here. So that is basically fair value adjustment, and always these are by the subsidiary. So the first thing we need to do is basically to determine the revaluation gain, because we are told the items of net asset were revalued. The carrying amounts, the fair value was the same, with an exception of an item of plant. An item of plant, we are told whose fair value was above or was more than the carrying amount with an amount of 1 million. But we take that as 1,000. Automatically, this is what? This is a revaluation gain. Was it accounted for? No. So therefore, number one, we will add this to the group PP. We add that to the group PP. Number two, this is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, it means that when computing the goodwill on acquisition of Shape, is it Shape? Yes. We are going to use that as one of the pre-acquisition revaluation what? Or pre-acquisition reserve. Number two, we need to compute the depreciation other charge. How do we compute this? We take the revaluation gain, the same formula, divided that with the remaining useful life times the proportion of time. The proportion of time is said is the time difference between the date of acquisition and the date of consolidation. How many years, how many months do we have between those two dates? The date of acquisition is this. This is the date of acquisition, the date the parent company acquired the subsidiary. That is the date of acquisition. The date of consolidation, doc, is the date we are required to prepare the group account. You can get that date in the requirement, specifically in Part C. When are we required to prepare the consolidated statement of financial position? 31st of December 2024. 31st of December 2024. So in this case, you can see that here, how many years or how many months do we have between those two dates? How many years, how many months do we have between those two dates? How many years, how many months do we have between those two dates? Yes, we have exactly 1 year. We have exactly 1 year. So meaning that we compute depreciation other charge by our subsidiary for 1 year. So we use this formula, revaluation gain 1,000, divided that with the remaining useful price. The remaining useful price is given in note number 1. The remaining useful price 5 years. I hope you can see that. Rin, 5 years. The proportion of time 1 year. 1. Sasa? Yes. So this will give us what? This will give us, I've said is 1,000 divided by 5 times 1. Basically, this will give us 200. 200. So this one, number 1, will be deducted from the group PP. Number 2, we also deduct this from the retained earnings of who? Of the subsidiary. Now, if, for example, still we were required to prepare the consolidated statement of profit or loss, we say that this one should be added to the group cost of sales. But are we preparing the consolidated statement of profit or loss? No. So the only adjustment is to less this from the group PP, and number 2, to deduct it from the retained earnings of who? Of Shape. This is the company which revalued the asset. And it is basically the company which are the charge toward depreciation. So if you check on whatever you have done here, whatever we did in the other question is just the same. Just the same. So this is something you must understand, because you'll come across in all questions for group accounts. In all questions for group accounts, you'll be told the subsidiary company revalued the asset, but basically never accounted for that. So let's move to the other point now. We move to the other point. We move to the other point number 2, and you're told Pool Limited measures goodwill and non-controlling interest using the fair value. So this, the same point we came across in the other question. Anytime you're given that information, that's the policy of the parent to measure NCI at fair value. That is basically to help you to know the method to be used in the computation of goodwill. So automatically here, we are going to use the full goodwill method. But if you check, I think on this question here, yes, actually we are told the fair value of the non-controlling interest in shape was 5.7. That one will be used in the computation of goodwill. Quite simple, quite similar to the other question we did. Number 3, no working share. Number 3, we are told during the year, which ended 31st of December 2024, shape, our parent, not our parent, our subsidiary, sold goods to Pool for 4.5 at a markup on cost of 25%. Now, this is basically what we refer as intra-group trading, sales between the parent and the subsidiary. If we were preparing the consolidated statement of profit or loss, this one should be deducted from the group revenue and the group cost of sales. Are we going to make that adjustment here? No, because we are not preparing the consolidated statement of profit or loss. But automatically we say that any time you see that, we will automatically compute and release profit and maybe amount of intercompany debt. Let's see what you are told. So we are told in sentence 2 that that 1/3 of these goods was still held by Pool on 31st of December 2024, and the balance payable was still outstanding. Now, two adjustments there. Number 1, because some of the goods were not yet sold, we have now the unrealized profit. We have to compute the unrealized profit on inventory. And basically, this unrealized profit is always by the selling company. The selling company here is Shape. This is the selling company. How do we compute this? We said we take the unsold goods, goods times the gross profit margin times the gross profit margin. So in our case, we can be able to comfortably determine the unsold goods, but we are not given margin. I hope you can see that. We're given markup of 25%. So what you're given is the gross profit markup, which is 25%. 25% is the same with a quarter, because that is 25 all over 100, which is a quarter. And actually, we said once we are given this one, we can comfortably determine what? The gross profit margin. The gross profit margin will be equal to a quarter, and then to the denominator, we add the numerator, which is 1. So therefore, our margin will be 1 over 5. That is basically what we say. Having that, we need to move and we compute the unrealized profit. So we are going to compute the unsold goods. And basically, we are told the goods not yet sold were a third. A third of what? A third of the goods which Shape sold to Pool, and the goods sold by Shape to Pool, they had a value of 45. That is basically the unsold goods, a third of this. And then we multiply that with the gross profit margin, which is basically 1 over 5. That's how we get now what? We get the amount of unrealized profit. This will give us 15 divided by 5. And that will give us what? 300. So 300 is the amount of unrealized profit. 1, this one will be deducted from the group inventory. Number 2, we also deduct this from the retained earnings of Shape. And then if, for example, we are preparing the consolidated statement of profit or loss, we add that to the group cost of sales. Are we preparing the consolidated statement of profit or loss? No. So therefore, that adjustment will not be done. So we only have 2 adjustments. That's that from the group inventory and also the unrealized profit. And then in the same point, we are told, and the balance payable still outstanding. The balance payable still outstanding. So now that balance which was payable, which was still outstanding, That is basically the amount of intercompany debt. But in our case, we are not given the amount of intercompany debt. So how much will be the amount of intercompany debt in that question? The balance payable. The balance payable is what? How much amount was supposed to be paid by the buying company? Remember, it is 𝐎𝐻 which sold some goods to Pool. How much amount was supposed to be paid by Pool to 𝐎𝐻? $3,000. But Tito, where are you getting 3,000? Yes. The balance outstanding and the balance payable was outstanding. How much amount was supposed to be paid by the parent to the subsidiary? If I sell some goods to you, you should pay me. How much amount was the parent company supposed to pay to the subsidiary? How much amount? How much amount? Should be 45. It should be 45. Because in this case, we are not told there was any amount which was paid. The goods this company sold to this had a value of 45. So we are told that is the balance. The balance is what this company was supposed to pay to this. It was 45. This amount was not yet paid. So this amount of intercompany debt, we less that from the receivables. We also less that from the payables. Yes. So that is basically the amount of intercompany debt. Finally, note number 4. We are told impairment review performed on 31st of December 2024 revealed that the goodwill arising on acquisition of 𝐻EP had been impaired to an extent of 10%, and the interest in 𝐎𝐍𝐿𝐶 was not impaired. I think we are basically done. What we need to do now is basically now we move and we answer our question. Now, this question was a very simple one, a very, very simple one. Yes. And in fact, before even we do this, I think we take a short breather because answering our question now should not take us even like 30 minutes because we are almost done. So once you're able to deal with it, but to know which items will be adjusted with this, the question becomes simple. Let me give you a small breather of like 8 minutes. We come back at 3:15 so that now we finish on what is remaining. We compute part A, what is required in part A, part B, and also part C. A break of 8 minutes. We come back at 3:15. Yes, we continue. Let's continue. And I want us to start with the part A of that particular question. Part A, and what you're required to do basically is we compute the goodwill arising on acquisition of our subsidiary. Remember, our subsidiary is called 𝐻EP. And I think as per the information which we have in note number 2, we have said that we're going to compute this goodwill using the full goodwill method. We're going to compute that goodwill using the full goodwill method, using the full goodwill method. So let's go straight to a part of that question. So whereby we require to compute the goodwill on acquisition. On acquisition of who? On acquisition of 𝐻EP Limited. 𝐻EP Limited. 𝐻EP Limited is our subsidiary. Our subsidiary. Basically, here we need to have 2 columns, and our figures are in thousands of shillings. Our figures are in thousands of shillings. So what do we start with here? We start with the purchase consideration, which was paid by the parent. The purchase consideration by the parent. And this purchase consideration by the parent, this one, we have it within paragraph 1. We have this within paragraph 1. We have this within paragraph 1. Yes, so basically this is how now we compute the goodwill. Anytime I forget to record, please remind me. Yes. So the value of Jolty at the end. So in other terms, what you're required to compute here, remember Jolty is a joint venture. We are required to compute what is known as investment in joint venture at the end of the year. That, in other terms, what you're required to compute here. The investment in what? The investment in joint venture, because this is the only item which you're going to recognize within the consolidated statement of profit or loss as far as Jolty Limited is what is concerned. Now, how do we compute this? How do we compute this one? I've said we start with the cost of investment. The cost of investment, how much amount was paid by the parent company in acquiring shares of Jolty, the joint venture. And then to this, we have said we add the group share log, the post-acquisition retained earnings, and then we less any impairment loss. But if you check on what you're told in note number 4, we are told that the investment in Jolty had not impaired. That information you have it in note number 4. Investment in Jolty had not impaired. We don't have any impairment loss. But we can start by recording the cost of investment. Remember, there is a purchase consideration paid by the parent in acquiring 50% shareholding in Jolty. So that information, we have it within paragraph 3 of our question. Paragraph 3, who Limited also acquired 50% of the equity interest in Jolty and obtained a joint control on 1st January 2024. The purchase consideration comprised of an immediate cash payment of 10 million. 10 million, that is the cost of investment. Then to this, we will add the group share of the post-acquisition retained earnings of who? Of Jolty. How do we get that? Now, first of all, if we go back to that paragraph 3, where we are given that purchase consideration of 10 million, we also told that in the other sentence, the retained earnings of Jolty stood at 2.5 on the date of acquisition. That is now what we refer as the pre-acquisition retained earnings. Pre-acquisition retained earnings. Now, can we go to the balance sheet of Jolty? In the balance sheet of Jolty at the equity, the balance sheet of Jolty, Paizo, my entire board is visible. So can you double tap your screen? Double tap your screen, you should be able to see my entire board. Double tap your screen. If you're using your phone, double tap your screen, should be able to see my entire board. Yes. Now, what I'm saying, the retained earnings which are given there in paragraph 3 is the pre-acquisition. But now, can we go back to the balance sheet of Jolty at the equity? In the balance sheet of Jolty at the equity, so we are given the retained earnings there. Now, the retained earnings we have in the balance sheet of Jolty 38, this one comprises of the pre-acquisition and post-acquisition. So what we're interested with here is the post-acquisition retained earnings. And because this comprises of the pre and post, so for us to get the post, we are going to rest the pre-acquisition. The pre-acquisition retained earnings is the retained earnings of Jolty on the date it was acquired as per paragraph 3. As per paragraph 3, and basically that is 25. So once we left 25, which is the pre-acquisition retained earnings, we will be left with the posts. And then we get the group share of that. The group share of that will be equal to 50%. We multiply that with the parent company shareholding in Jolty. In what? Jolty. Yes, so this will be 1,300. Then 50% of that will be what? Will be 650. So, and basically here we get 600 and what? And 50. So this basically what was required in that part of that question. Basically the marks are located there were 2 marks. So we are done with that. So then next we move to part C of the question. And basically we are required to do what? We are required to prepare the consolidated statement of financial position as at 31st of December 2024. Now the preparation of this is quite simple, because what we just need to do here is we combine similar items of assets and liabilities, those of the parent and those of the subsidiary. We don't consolidate a joint venture. Instead, what we're going to include here as far as the joint venture is concerned is what we have computed here. Investments in 𝐻𝐿T, and we are going to recognize that here as a non-current asset. So let's do that. So we start by recording the non-current assets. The non-current assets. Now, for the non-current assets, basically, we start with the, let's go back to the statement of financial position for individual companies, which are given below paragraph 4. So we start with the PP, property, plant and equipment. So we are only combining that of the parent and that of the subsidiary. We don't consolidate a joint venture here. So we have 36,400 plus 18,500. And then we make the necessary consolidation adjustment. We have any adjustment affecting PPE? Yes. So from this, whatever you have in note 3. So to the group PPE, we add 1,000, and then we less this depreciation at a charge of 200. We add 1,000, and then we minus 200. No any other adjustments. We get the final value there. We get the final value. We get the final value. We try to move at a speed because of time. Yes, what are you getting? 50, 55, 55, huh? 55, 600, 700. Yes, should it be 500? Should it be 700? Someone else to confirm. So then below the PPE, we have the investment. So we have investment in shape, investment in 𝐻𝐿T. We say these are purchase consideration which were paid by the parent. Do we include them here? No. But in relation to the acquisition of shape, we said we include the goodwill on acquisition. The goodwill on acquisition of shape limited, which you have computed here, 13,50. In relation to the acquisition of 𝐻𝐿T, we include this. So we include what is known as the investment in what? The investment in 𝐻𝐿T, 𝐻𝐿T Limited, investment in 𝐻𝐿T Limited, or the investment in joint venture, which is 10,650. So I think we are basically done. We need to proceed and we record current assets. Current assets. Now, for the current assets, 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 for the current assets. Yes, I think it is your internet which may be having a problem. My screen, my video is okay. I can confirm that from my side. Yes, check your internet. Yes, now under the current asset, what do we have? We have inventory. For the inventory, we add that of the parent, which is basically 21,400, plus that of the subsidiary, which is 13,000. And then to this we have amount of unreleased profit, this one, which we said we less from the group inventory, we less that there. So that will give us 21,100 plus 13, which basically will give us 34,100. 34,100. Then below that current inventory, we have the trade receivables. Trade receivables, we do the same. We take that of the parent 18,500 plus that of the subsidiary, which is 11,400. 11,400. And then to this, we less the amount of intercompany debt. Amount of intercompany debt, remember this 45, we say it should be deducted here. 45, this will give us 14,000. We have the cash and basically cash equivalents. So we have 12,700. And then we have 81. Any adjustment here? No adjustment. So we just need to get the total, which will be 2,800. 2,800. Do we need to get the total? No need of getting the total asset, because in fact, like in this question, I don't think we will compute the group retained earnings and also the NCI. We said moving forward, those are two items we will not be computing. Then we move and basically record items of equity. We start with the ordinary share capital. And I hope you can be able to recall we said share capital, we only include that of parent company only. That of parent company only, which is basically 50,000. So equally for the share premium, in this question, we will only include that of the parent company only. And that is basically how much? 5,000. Then below that, what do we have? We have the retained earnings. So the retained earnings, we said moving forward, that is an item we will not be computing, but basically that is an item we should compute, includes there, but no need of that. We say in this question for group accounts, it's not a must you have to get everything correct. It's not a must you have to get everything good, correct. So retained earnings, we just ignore that. There is also something else we say should be computed and included here, called the non-controlling interest. Equally, you can just ignore that. You may decide to do what? To ignore that. Don't bother computing that in an examination setup. Because that question, even by doing it like that, you'll have gotten all the marks. You'll have gotten all the marks with you. Be having all the marks. Then from there, finally, we record the liabilities. Liabilities, remember, you should combine. You should combine liabilities of the parent and those of the subsidiary. So we start with the non-current liabilities. Non-current liabilities, we have, first of all, the long-term borrowing. Long-term borrowing. So we combine that of the parent, 18,000, plus that of the subsidiary, 85. Any adjustment? No. That will give us 26,500. Then there is something we should not forget to include here, and that is the deferred consideration. Don't forget to include that here. The deferred what? Consideration. And the deferred consideration is not this one, because this is at the start of the year. The deferred consideration at the end, which is 11,000. 11,000. Finally, we record the current liabilities. So the current liabilities, we have trade payables. Trade payables, we take those of the parent 16,300 plus 95, and then we less the amount of intercompany debt. The amount of intercompany debt is this one, 45. So this will give us 5,000 plus that, which will give us what? Which will give us 21,300. 21,300. And then finally we have tax. We said anytime you come across a component for tax, in this question for group account, this is always a free mark, because no single time these items for tax, this component for tax will be adjusted. So that will give us what? That will give us 13,400. 13,400. I hope those are the values you're getting. I hope those are the values you're getting.